see what's moving the markets. Visit Bloomberg.com webinars.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Live from New York, CPI data 2 hours away, going into it. Here's the price action. Equities up a third of 1% on the S&P 500. Futures pushing just a little bit higher. The 3-day winning streak on the S&P snapped yesterday with a decent day of losses, actually. On the Nasdaq, we try and bounce back as well, up a half of 1%. In the bond market, 2-year yields about 20 basis points below the highs of last week at about 461 on a 2-year this morning. Yields trying to bounce back as well, up 3 basis points. Your 10-year 4.1%. Your euro dollar, the pain's still to come in Europe. How many times have we talked about this? We've had the tightening cycle. Let's talk about the consequences. 99.53, Tom, on euro dollar, negative 0.6%.
Scope and scale, magnitude. We're talking about inflation here, and we'll do this with Sarah House in a moment. But John, over there, it is a magnitude more urgent given an active war in Ukraine.
What can they do about it?
What can they do about it? The answer is nothing. They got a war.
The criticism's going to build even more when growth starts to roll over, Tom. What can they do about it?
Well, I go back to the headline of the month. We don't have time now to recapitulate it, but Governor Bailey with a stretched out 2-year recession, I have never seen that, ever.
If they deliver what's priced in the rates market, and they're trying to push back against that, they're trying to walk much more, I think, more of a delicate dance over the Bank of England than maybe the Federal Reserve.
By mandate, maybe.
I think they're worried. I think you can really sense they're worried about the growth backdrop in a way that this Federal Reserve is not. Next year is going to change. When the dual mandate of the Federal Reserve is in conflict, different picture. And when that starts, I think, Lisa, we have a different kind of tension over the Fed.
Did you see what Charlie Evans over the Chicago Fed said yesterday?
I saw that in the exit interview.
In his exit interview. Basically, he's going to leave. He's going to give up his post in January. And he came out yesterday in a speech where he talked about the fear that the Fed was going too fast and that if the Fed is too aggressive and overshoots, that they could struggle to get inflation above 2% over the long term like it had been. So going back to the same regime.
Right.
You don't hear this from anyone else. And I think it's interesting as he exits the Fed that he sounds this note of incredible dovishness that is more sensitive to these balanced risks.
And sophisticated and freshwater and Carnegie Mellon and all that. But what's important there is the history of the 40s into the 50s, where you went from rampant post-World War II inflation down to true, John, we actually got to a true deflation with early Eisenhower.
You just have to ask them for their assessment of the risks around policy right now. And when they tell you that the risk of doing too little outweighs the risk of doing too much, that's an implied commitment to over-tightening.
Yes.
It's there. It's in the language of the Federal Reserve. That's a commitment to over-tightening.
Well, you know, it's there, and it's the history, and of course the skeleton of the Bank of Japan, I'm going to say 15, maybe 20 years ago as well. A good conversation to begin with Sarah House, senior economist at Wells Fargo. Sarah, what we love is we have Michael Pondon from Barclays with the fixed income dynamics of today's report, and now we're really going to drill down. What part of headline inflation will you study first?
So one I'm looking at in terms of where it comes in versus the overall consensus is looking at a few pockets that I think we see some disinflationary forces gathering. So I think autos will be a big one today, not just used, but vehicles, given that we have seen inventories pick up there, and I think a lot of pricing constraints on the part of the consumer too. But also, of course, shelter. That really sets the tone for not just what inflation does in October, but what it'll do in the months ahead. So I think those are two of the key categories to dissect.
Will the Fed dissect? Will the Fed partition, or do they just look at the two statistics that come out?
No, they'll partition it. So in addition to just the headline and core, so they do like to look at various slices and dices of the data. So whether that's the median CPI, which I think gives you a nice, just clean look at an alternative measure of the core, whether it's the sticky, the flexible CPIs that we get from Atlanta. But I think one of the things we've seen is a lot of questions over do they discount shelter, given that we do see that rental price pressures are certainly coming down. But we saw in Powell's press conference after the last meeting that no, he is very much looking at shelter, which I think will be important as we think about what this print means for near-term Fed policy.
If Fed officials had a live blog and were discussing a CPI print, as essentially perhaps you could say they are in terms of just how many speakers we have today, what would you be looking to understand from them after the CPI print?
So I think I'd be looking at some of the short-term versus more persistent forces of inflation. So what we're seeing in those areas that can move pretty quickly, so things like travel services prices, those reset, the autos which we already mentioned, but some of the more persistent ones. So whether that's shelter, but also some of the more mundane services. So what we see in some of the medical care, like physicians or hospital services, what we're seeing in tuition and childcare, home insurance, auto insurance. And so I think some of that dissection of which of these categories have longer momentum, more scope for catch-up, and which ones tend to move and reprice more quickly.
So we've been talking about how the election doesn't matter and how we're kind of beyond that, and now it's all about CPI. But would you completely agree on this? And yesterday, I elicited groans from myself when I started talking about debt ceilings and the potential for some sort of risk or brinkmanship heading into a default. But I am seeing more and more notes that this is actually hugely concerning and could tip the scales in terms of how deep the recession is, just simply because of spending cuts and because of the uncertainty fueling even higher yields in the 10-year. What's your view on the importance of these types of tit-for-tat in D.C.?
Well, I think the fact that we will have, it looks like very likely like we'll have divided government with the Republicans at least taking the House. It does mean that there won't be any major fiscal packages here in the near term. But I think that does mean that the potential depth of an upcoming recession, it could be even deeper because you might not have that agreement over fiscal support. Now, if it's deep enough, you might see some bipartisan help. But I think particularly given the inflationary backdrop, some of the fears of how much fiscal policy contributed to that, I think overall we get a pretty muted response from the fiscal policy sector come that next downturn, which leaves monetary policy as really once again the main lever for supporting the economy.
Sarah, 99.825%, excuse me, I've got election details in my head. 99.825% of our audience on radio and TV look at headline inflation. There's no core, there's no Dallas trim mean. Walk us through again why animals like you, like the chairman of the Federal Reserve, don't look at headline inflation. It's nonsensical.
Well, we do look at headline inflation, both us and the Federal Reserve, because that does have a meaningful impact on consumers' ability to spend in real terms. But the core and various cuts of it are so important because that gives you a better sense of where inflation is going, how quickly it might come down. And while there's very likely that we'll see directional improvement in inflation, one has to be careful about losing sight that it still remains a long way back to 2%.
Okay, a long way back to 2%. Where are you modeling that we pause, if you will? On a core inflation basis, we're 5 or 6-ish. Do we pause at 3? Do we get stuck at 4?
So we believe that you can get core CPI coming down to, let's say, roughly 3.5% by the end of next year. But that's still well above the Fed's target, even when you adjust it for their 2%, 2% being really focused at the PCE deflator. We forecast out through 2024, and even then we don't get core inflation moving down to 2% consistent levels of inflation. I think that's going to be an important story over the next year or so, is that there is a lot of disinflationary forces here in train. I think we're likely to see some pretty marked improvement over the next 12 months or so, but squeezing out that last little bit of inflation to get all the way back to 2%, that's going to be a much harder ask. So it's not just about supply chains, but it's also about what we're seeing in terms of the labor market, the wage cost pressures that we continue to see, and the fact that, sure, inflation expectations haven't necessarily broken out of historical ranges, but they're at the upper end of that. And so we're still overall, I think, in a very elevated inflation environment.
Does the conversation change, Tom, when we get down to 4? Do they start to tolerate something different?
I thought
they're not going to signal
brilliant.
that now. We know that. But does that change in a year's time?
I mean, I hope the governor of the Bank of England was listening to that, because that's where we're going. And
Governor Bailey always tunes it.
I would say the U.S. zeitgeist now, John, is all focused on 1 month out, 3 months out, 3 meetings out and that. And Sarah House and Andrew Bailey are way out.
Sarah House there of Wells Fargo. Lisa, I'm pleased you brought up the midterms. I caught up with Morgan Stanley, Michael Zezas, yesterday, and he talked about the importance of the midterms potentially taking on increased importance over time. And I've been asking this question, I know you have as well. We have to ask ourselves, what is the optimal policy mix now? And what do we think the optimal policy mix should be in 12 months' time? Now, I think if you ask people, they want a Federal Reserve to deal with inflation, and they want fiscal policy just to not get in the way. Stay out of the way. We don't need a UK situation here in America. Fine. Is that going to be the story 12 months from now? Is that the optimal policy mix in 12 months?
Well, and some people are saying that actually the gridlock that you are going to see in D.C. is going to cause a deeper recession, actually. And because exactly to that point, over the longer term, the lack of fiscal response and also the fact that you're going to get cuts in spending, right? You are actually going to get cuts because in order to not default, in order to meet that debt ceiling limit, and because of the aversion to raise it, people are going to cut costs, which is going to lead to an even less fiscal
The politicians are going to cut costs? They're going to be budget cuts?
Yeah.
I just don't believe it. We're going into an election. The election starts now. Humpty Dumpty, Trumpty Dumpty, and all that. It's starting right now.
Just to be clear,
nobody's going to cut
anyone's
costs.
just tuning in, Tom referencing a front page of the New York Post this morning. Lisa's raising an important question, Tom. Right now, the consensus around the economy is short and shallow if we get a recession. I actually think when it comes to the policy mix, it raises questions about duration and maybe not depth so much. If you don't have that circuit breaker from fiscal policy or from monetary policy, this downturn can go on for maybe longer than you think it can.
But we've said that surveillance has said that all year. I'm sorry, the x-axis just goes out.
I will give you this, not from me, but from Robert Dent, a former Fed economist who works at Nomura, who wrote, instead of fiscal support, we're expecting debt limit volatility, government shutdown volatility, and potential spending cuts. And it's the reason why he sees the unemployment rate going up to 6.4% in a recession lasting about 15 months. So just to give you a sense of how people are shifting this.
If they do a crime bill, is someone going to vote against that right now?
I don't think so. What kind of crime bill would they do?
I don't know. You know, they'll make it up. They got to do something to show that they're against
crime.
The
interesting split at the moment when you speak to people in fixed income. The state level finances, it's a very different situation compared to what could happen at the federal level. They could loosen the purse strings.
Yeah, well, they've got the cash for now.
For now. Futures up 0.4 on the S&P. That was fun, wasn't it? It was good. It was good, Tom. Nice.
They do okay there?
Oh, you're fantastic, as always.
It's Election Central.
From New York, this is Bloomberg.
Always a good time. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Figures out today are likely to show that U.S. inflation moderated only slightly last month, and that's keeping a fifth straight 75 basis point rate hike on the table for the Fed's meeting next month. Economists forecast that the Consumer Price Index will show a 7.9% increase on an annual basis. The CPI comes out at 8:30 a.m. New York time. President Biden says he still plans to seek re-election and will likely make it official early next year. The president spoke after Democrats avoided worst-case scenario congressional losses in midterm elections. Now, he said the final decision on running again depends on his health and discussions with his family. Meanwhile, British Chancellor of the Exchequer Jeremy Hunt is considering whether to impose the top income tax rate on more Britons. Bloomberg's learned Hunt is thinking about lowering the $172,000 threshold at which the 45% tax rate is paid. Now, Hunt and Prime Minister Rishi Sunak are looking for more than $57 billion of spending cuts and tax hikes. It was the largest single-owner art auction in history. In just 2.5 hours Wednesday night, Christie's presided over the sale of just over 60 artworks for an unprecedented $1.5 billion. Now, they came from the collection of late Microsoft co-founder Paul Allen. Among them were works from Lucian Freud, Gustav Klimt, and Paul Cézanne. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Global inflation and recession, an energy crisis intensified by war, and the aftermath of a pandemic. Next week, world leaders meet in Bali for the G20 summit. And Bloomberg is there bringing you the news and analysis.
A confluence of economic, climate, and security crises make it a uniquely challenging time.
All of these are pointing towards a big slowdown in trade.
It all starts next week, only on Bloomberg, your global news authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
Right now, we're in a higher interest rate environment to try to bring inflation back down. Financial markets seem to believe that inflation should fall back down towards our 2% target over the next couple of years. I hope they're right. I know that we're going to do what we need to do to bring inflation back down.
Neil Kashkari there, the Minneapolis Fed president. His words, any talk of a pivot is entirely premature. Price action looks like this on the S&P 500. Equity futures, positive 0.4%. Positive on CPI data that is about, an hour and a bit away? An hour and 42 minutes away, Tom. Yields unchanged on a 10-year, 4.0885% on a 10-year. Euro dollar, negative 0.6%, just in and around parity over the last couple of days, 99.48. And crude from the 90s back to the 80s again, 85.37, down 0.5%. The rumor mill in China still in overdrive. And Chinese officials, Tom, seemingly pushing back against this idea they're going to reopen and drop COVID zero anytime
that's
soon.
sort of where we are right now. It could change tomorrow. It could change today. I mean, I really don't know where we are as we go to Bali. Emery Horton again will be in Bali with the president. And did she allude that the president of China may be there? You wonder if they'll meet. I guess it's like anticipated.
Anticipated is the right.
Is that the right word?
The right word, I think, into next week.
We'll see, of course, a long ways away, and it'll be interesting there. And, of course, one of the themes in Bali with G20 will be climate. It was one of the themes in the election, maybe below the radar, of crime, immigration, inflation, the economy of America. But nevertheless, it is always with us. Michael Regan joins us now, administrator, yes, of the Environmental Protection Agency, but far more from the backbone in the fields, the hills of North Carolina. He's got an understanding of the value of climate to our south. Michael, thank you so much for joining us from COP27. The problem with these interviews is we tend to go big and broad. I want to go narrow, and it does go to the president's back and forth on hydrocarbons, on oil, on nat gas, and also on methane emissions from oil. Take us into that little narrow window of methane emissions and what can be accomplished.
Well, thank you for having me. And, you know, the president has pledged that we'll continue to move forward to reduce global warming, to reduce these emissions that cause global warming. He never pledged that we would get out of it immediately overnight, but he pledged that we could work our way out of this. And so I think when we talk about methane in particular, the conversations that I'm having with the oil and gas sector, with technology providers, with, you know, the U.S. Chamber of Commerce, is that we see an opportunity to deploy technology to reduce methane and actually save the loss of gas and gas products while saving the planet and protecting public health. We know the technologies exist. We know that there are advanced technologies and business models that can adjust to reducing methane. And so EPA's job is to put some rules of engagement in the role so that all companies know and can make these longer-term investments.
How does EPA's job change with the election, including a big Republican win in your North Carolina? I'm fascinated how the oil and gas industry that has a GOP bent will change and amend coming off this election.
Well, you know, the president has had a historic 2 years in passing historic legislation with the bipartisan infrastructure law, the Inflation Reduction Act, you know, resources coming to EPA to help with and enhance the regulations that we are required to put in place by law. So I don't think the elections will change the fact that EPA has legislative authority or authority provided by the legislature or Congress to pursue the reduction of greenhouse gas emissions to protect public health and protect the planet. We're going to continue to move forward and do our job, but the resources that flow from the Inflation Reduction Act just help with that public-private partnership to pursue these reductions, so we're not solely reliant on regulations alone.
How complicated is it right now, Michael, to be with this mandate to reduce emissions at a time where people are prioritizing fossil fuels in light of some of the shortages, in light of the war in Ukraine? Is it perhaps taking some energy away from what you're saying or making it more difficult to argue your cause?
You know, it's a speed bump, right? I mean, I think we find ourselves in this position where many countries are overly reliant on fossil fuels provided by, you know, countries like Russia at a time where it's inconvenient. And we are seeing that this unprovoked war with Ukraine is causing pain globally. If we were not so dependent on these fossil fuels, if we had made the proper investments in clean technologies and energy efficiency and more domestic opportunities, we would not see the price volatility that we're seeing internationally. So it's a wake-up call, right? Number one, it is very inconvenient, obviously, but number two, it is really forcing all of us here at COP to think through how we continue to double down and invest in alternatives to fossil fuels.
Michael Regan, thank you, sir. Michael Regan there of the EPA. The President of the United States will be in Egypt tomorrow. Tom, what a busy schedule for the President over the next week to Egypt and then on to the G20.
It's exhausting. I don't care how cushy Air Force One is. This is a lot of miles. And I believe that on to Cambodia even as well. I think that's scheduled. And you just, he's going to come back. First of all, he's going to come back to a Georgia election. I mean, that's the first thing. He's going to celebrate the holidays, which is a good and wonderful thing. But I agree, it's an exhausting trip.
And we'll see how consequential that Georgia election might be. Another piece of news I wanted to draw your attention to, Elon Musk, in his first email to Twitter staff, ending remote work. Ending remote work. How quickly that story's changed. So a year ago, 18 months ago, we were talking about the death of the office. I'm sure, Lisa, you've had similar conversations. I've been speaking to people in the market who run, say, a trading desk or a division within a bank, an asset manager, who have said that all of a sudden people are starting to come back to work. The why? let's just say job security has been replaced with a little bit of job insecurity over the last few months.
We've talked about this, right? How much is an economy that perhaps isn't as hot? Perhaps that's going to drive more people back to the office to make sure that they get that face time or make sure that they're seen as essential. But it's also the bosses want to see them back there, like Elon Musk.
Well, they've
saying
wanted that
get
for a
back
long
to-
time.
And they've wanted that for a long time, and now they can exercise that power perhaps a little bit more when the balance of power has changed a little bit. Elon Musk isn't really making friends there. He comes in, he cuts half the staff, he says don't work from home anymore, throws everything up in the air. I mean, can you imagine some of the morale there?
He did one of the Spaces things. Do you know those Spaces things on Twitter? I kind of like them. I tune into them sometimes. He was doing one of them, and he was being interviewed, Tom, about advertising and the platform and the changes we could get. And you can see on Spaces who's listening. I can tell you, Tom, pretty much every single brand under the sun was there listening to that conversation with Elon Musk yesterday. There is a ton of uncertainty about where these advertisers want their brands to be and whether Twitter is still a platform for them.
I remember when Tesla was a failure and everybody marked this guy down as buffoon, and boom, all of a sudden it was a success. Can he do that pixie dust with Twitter?
The problem is that his message is not cohesive. It's not clear what his ultimate goal is. I mean, was he giving a better sense to advertisers yesterday?
I think it was somewhat confusing. Can he repeat the act, Tom? I'm with you. That's the big question. Live from New York, CPI, 1 hour, 34 minutes away. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
No one covers the world like Bloomberg.
The writings on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
You look at the midterms, the market generally does better after that. I just don't think that this time that's going to carry much weight.
It really doesn't change the near-term picture, and the near-term picture and the near-term risk is about Fed, it's about inflation.
Inflation has already peaked. I think it is going to gradually fall.
We are still racing ahead on all cylinders with an incredibly strong jobs market.
Markets have not adjusted to this new Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
CPI data 90 minutes away, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures are just about positive on the S&P, up 0.25%. TK, the data, 8:30 Eastern Time.
8:30 Eastern Time, we'll go beneath the headline data. And John, on inflation, you just partition out. You've got to partition out real estate. I mean, we've heard in two interviews this morning. Okay, excuse me, folks. It's called shelter, not real estate.
Wasn't a correction.
Rent,
I was just echoing.
OER, housing, whatever. It's, I looked it up the other day. It is exactly 33.
I know.
John, it's 33% of the pie. I mean, people spend 33% nationally on average on shelter.
Nice. You're very delicate this morning.
Very good.
Okay.
That's what we're going to see.
You get the data, and then you get the Fed Live blog straight afterwards.
I love this.
Who is not speaking today?
Well, Fed Chair Jay Powell for one, Lael Brainerd for another. So the people who actually perhaps are central and who might disagree with each other actually in terms of how quickly the Fed has to go, which is interesting. But we're not getting from the leadership necessarily. Still, whether you start to see a growing number of Fed officials talk about the risks of the overshoot and what that could do longer term to the economy and potential inflation may be interesting, just because we've started to see it around the edges from the likes of Charlie Evans.
Isn't that why they're slowing down anyway? Or at least suggesting to us that they will slow down?
Yeah, I mean, the, cumulative lags and all that stuff. Sure. At the same time, if you hold rates at 5%, there is a cumulative effect of that people haven't really fully gamed out because it's impossible to do so.
But the debate here, and for people watching who aren't the sophisticates of John Farrow and Shelter, the bottom line is there's a group of people saying we're super restrictive. We're restrictive.
Are we?
And there's that's the debate. And to me, it's people ignoring the elephants in the room of CPI. They're ignoring, I'm making a joke about it, but you're right, John. They're ignoring shelter. They're ignoring selective food. Can we do that? 100% of our audience is saying that's nuts.
They're looking at inventory over at retailers and saying, look, goods disinflation is starting to appear. And other people are saying, well, hold on a second. That was the story of last year. You're seeing a shift. It's stickier. It's broader. It's gone to services now. That's the problem for this Fed. They're constantly chasing their tail, Tom.
I agree with the expos chasing the tail, and after this report and the next report before the Fed meeting, they're going to be ever more ex-post and behind.
Well, when you're talking about why this matters, what's the difference between holding it at 5% for 2 months versus a year? I'm going to put this number on it. The Bloomberg Barclays Aggregate Index for the United States, that is top-rated debt of governments and corporations, stands at $23.6 trillion. If that resets at another level, what does that do to an entire nation's in terms of borrowing costs and in terms of abilities to borrow?
Sure. I'm going to throw this out there because I think about things a little bit differently sometimes. I don't think the end of hiking is the same as the end of tightening.
Correct.
I think if you pause at 5% and the economy rolls over and you don't cut, that Fed's getting tighter. Don't you think that Fed's getting tighter in that world?
Yes.
If inflation's coming down, if growth is rolling over and they remain at 5% and they don't cut, that Fed's getting tighter. And that's why I push back around this idea that maybe we've seen sort of like peak Fed. Peak Fed for me, and I think for others too, is if you have a recession and they're not cutting interest rates. That's when you're going to feel some real pain.
Tightness is a relative game. I think that's another way of saying it. And when the relative game changes into a weaker reality, all of a sudden, the Fed's position carries a lot more weight to do nothing rather than just continue to tighten.
Nicely put. The market looks like this.
Well said.
Well said, Bramo. Equity futures up 1/3 of 1%. Look out for Shelter later.
Boom.
Yields unchanged on the 10-year. Lisa, about 4.1% on 10s this morning. Euro dollar, stronger dollar, weaker euro dollar. 99.44.
All right, 8:30 a.m. we get that U.S. October CPI. We're expecting it to be 7.9%, which is coming down on the headline figure from the 8.2%. Does that matter? Is it really going to be the month over month and the energy and food that people are going to be parsing through? And then, of course, people will dismiss this as not as important as the next one that we're going to get in December. At 1 p.m., we get an auction. U.S. selling $21 billion of 30-year notes. Tom always dismisses this. However, it is important to note that yesterday's moved the market broadly. It moved equity markets because it did not go well. 10-year yields were much higher in the end sale than people had been expecting. And a lot of people were wondering why, a whole host of reasons we can get into throughout the show. And today, let's talk about the live blog that John labeled as such. Fed Speak, including Philadelphia Fed President Patrick Harker, Dallas Fed President Lori Logan, San Francisco Fed President Mary Daly, Cleveland Fed President Loretta Mester, and Kansas City Fed President Esther George.
Can't wait. A little bit later, Tom. It's like a who's who of Fed Speak.
It's
you excited for that?
You
were about to say out of control.
Out of control.
Out of control.
I just think it's
there
ridiculous.
It is. Boom.
Just say it.
Yeah, exactly.
So do I want to hear from 5 Fed officials or do you want to hear from Phil Camporella?
I want to hear from Phil.
That's what
joins us right now from JP Morgan Asset Management Portfolio Manager. Phil, let's start here. When do we stop calling this a bear market rally and start calling it a bull market? At what point do we do that?
Yeah, not yet, John. So I think, first of all, happy CPI Day, which isn't really happy this year because it's been a recurring nightmare for investors as inflation has been very, very slow to come down. It's caused terminal rates to jump. It's caused the dollar to rally. It's caused equity markets to fall, right? So it's been a recurring nightmare all year. And I think that's the reason why we're still underweight, while we're fading some of these rallies, and why we don't think that the rallies have much legs, at least through the end of the year. Because as I keep telling people, and it's like Groundhog Day, there's a terminal rate problem in the equity market. In other words, we have no idea when the Fed is going to stop. And they mentioned last time, maybe we'll pause and maybe there's a lagged effect to all of our tightening. But that's besides the fact. If we continue to get sticky inflation, there is no Fed member that wants to go down in history as losing the fight on inflation. And that's why we're cautious on the equity
That's
market.
every behavioral action I've ever seen from the central bank coming off what Bank of Japan did 20 years ago. The real yield, 1.65%. Translate a higher real yield as they move to some form of terminal rate over to the equity market. Why should stock pickers or index buyers worry about a 1.85% real yield?
Yeah, so it's the opposite, Tom, of the TINA trade. Remember last cycle? There is no alternative. Cash rates at zero, negative real yields, helping mega cap stock names, helping the cap-weighted S&P 500 index do really well. It's the opposite of that now. Now there are a ton of alternatives, Tom. I can't believe how much I'm talking about things like cash rates and T-bills and a 4% risk-free rate. And that just raises the barrier of entry into all of those asset classes that did so well when PEs went to the moon in the last cycle because there was no alternative. So cash for us is a nice alternative. We have 10% of our strategy in cash. That's the most we've ever had in the strategy in cash. And also in the front end of the curve, with the Fed jacking up the yield curve in the front end and going by 75 all the time, there's really high quality credit where you can get a 6% yield, Lisa.
Wait, can we sit on this for a second, Phil? 10% of your portfolio, the highest of all time. Can you give us a sense of how you've built that over the year and whether you could see it going even higher?
Yeah, so I think even higher, Lisa, would be in a world where the Fed would have to break the back of the economy in order to get inflation back down to their targets, right? That's to be determined. That's a tail risk, so that would be even higher. And I would say, summer-ish is when we started to build that up. Remember when we got that CPI number for May, and then the Fed had to call the Wall Street Journal and say we've got to do a 75 basis point hike. So that's when we started to raise cash in the portfolio, and we've kept it there. And again, I can't stress enough, that was trash in the last cycle. The opportunity cost of holding cash was so high because rates were at zero, and now again it's raising the barrier of entry into every other asset class if I can sit on a risk-free rate at 4%.
So when you talk about potential more downside risk in equities, how much are you looking at the potential for triggers like Bitcoin and FTX collapsing and other types of events that might seem peripheral but that do have forced selling on the other side of them?
Yeah, Lisa, this all comes down to sentiment, right? So if folks are seeing things that they presume to be safe, right? As the bottom is falling out, that's going to drive sentiment. Same thing when we talked about the UK a couple of weeks ago, right? That didn't necessarily affect the US because it was a very specific thing that was happening in the UK, but that was a sentiment driver. And rates were taken up higher here in sympathy. So I think just seeing volatility in things that were very, very good in the last cycle, I think just puts pressure on the market in general.
Once you've made the decision to go to cash, you've got to make a new decision. When do you get out of cash?
Yeah.
What's on the dashboard for you to make that call?
Yeah, so it's this race, John, between growth and inflation. So if we can get to a point, and by the way, a soft landing is not avoiding recession anymore. A soft landing, as you guys were pointing to, is a mild recession right now. So I think this race between growth and inflation, John, and I think the earliest we can think about it is the first quarter of next year, because one number does not make a trend. So if today's CPI number comes in good and people are cheering, you're not going to get the open mouth operations to be cheering, right? And the parade of Fed speakers, they're not going to be cheering anything. So I think it has to be at least two numbers, at least, and that'd be like a perfect scenario, right? But at least two numbers. I don't think the Fed is going to say anything in their December meeting that's going to be good for investors. So in the first quarter, if you can get inflation turning down and growth at or around trend or a little bit even below trend, John, that could be a good environment for the equity market that allows the Fed to pause at a time where they don't have to break the back of the economy. And then we're thinking about things like equities again, and even things like high yield.
Just finally, we used to joke about the Federal Reserve controlling the S&P 500 and having a price target. Is that a little bit more real now? Do you get the sense that they do have a limit on where they want this market to be and where they don't want it to be?
I don't think so, John, only because like that strategy of, okay, late 2018 into 19, worst Christmas Eve that we ever saw in 2018, Fed pauses in 19, and then starts to move rates down in July. You throw that out the window when inflation is at 8%.
Totally.
Yeah.
So now it's a Fed call.
Yes.
No longer a Fed put.
That's right.
And I'm thinking about the upside.
Yeah.
Are they uncomfortable with 4K? Do they like that? Do you get the feeling they want to push back against that?
No, they do. Yes, they do not want financial conditions to ease anytime soon, John.
That's the problem, isn't it, TK?
It is, and you watch the Bloomberg Financial Conditions Index, and it's a little more restrictive over the last post-election days.
Coming up, I'm going to bring you a call from Dan Ives of Wedbush on Tesla. Finally cut the price target in a big way. So we can talk about that in just a moment. Patrick Armstrong's going to join us in the next hour as well. Phil, this was awesome.
Thank you.
No Yankees talk, no Aaron Judge talk, Tom.
No.
Just
Judge looks awfully good in the Red Sox uniform.
You reckon?
When the Astros win, we don't talk about baseball.
That's true, right there. You got it.
Live from New York.
Good morning.
This is Bloomberg.
Victoria.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Control of the U.S. Senate comes down to 3 races where votes are still being counted. Each party needs to win 2 of those states to secure a majority. Georgia, Arizona, and Nevada still in play. And the race in Georgia headed to a runoff next month. Neither Democratic incumbent Raphael Warnock nor Republican Herschel Walker received 50% of the vote. In China, the government has once again reiterated its support for the COVID-0 policy. Still, it's urging more precise and targeted control measures against the virus. According to the state-run news agency, Beijing will try to minimize the impact of economic and social developments. Bloomberg's learned that crypto exchange FTX.com has told investors that without a bailout, it would need to file for bankruptcy. FTX co-founder Sam Bankman-Fried said the company faced a shortfall of up to $8 billion and needed $4 billion to remain solvent. FTX rival Binance had agreed to buy the company, but walked away after conducting due diligence. Meanwhile, U.S. regulators are investigating. New Twitter owner Elon Musk has emailed his staff for the first time and warned them of, quote, difficult times ahead. Musk wrote that there's no way to sugarcoat the message about the economic outlook. He also said remote work will no longer be allowed and employees are expected to be in the office for at least 40 hours a week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Wall Street prepares for the latest read on inflation.
This is a worldwide crisis. We haven't had inflation like this for 40 years.
The score is inflation one, Fed nothing today.
Will inflation finally begin to slow?
The economy is not responding.
We could get to a terminal rate that's even closer to 6%.
Instant reaction on Bloomberg Surveillance.
People are rethinking some of these inflationary inputs.
I'm on the Brent $100 watch.
Can the bear market rally continue?
Inflation in focus today on Bloomberg.
While the press and the pundits are predicting a giant red wave, it didn't happen. And I know you were somewhat miffed by my obsessive optimism, but I felt good during the whole process.
The President of the United States feeling good, live from New York City. CPI data, 1 hour, 12 minutes away. Going into it, equities look like this on the S&P 500. Equity futures firmer, positive, higher by a couple of tenths of 1%. Yields down by almost a basis point, 4.1%, let's call it, on a 10-year. This from Dan Ives of Wedbush moments ago, and on Twitter, and I've got the note as well, but let's start with the tweet from Dan this morning with Tesla up by about a third of 1%, 178 in the pre-market. New price target at Wedbush, 250, down from 300. Now sitting on top of the peak of the mountain with Tesla in a massive position of strength, Musk has managed to do what the bears have unsuccessfully tried for years, crush Tesla's stock by his own doing in what we view as a purely painful, dark situation. Dan Ives has been a big bull on that stock, Tom, for a long, long time.
Just because of time, let's move to the future. Is it presumed that Mr. Musk will sell other shares of Tesla?
Don't know. That's been the trend.
Yeah.
That's been the trend, and that's been the problem for the likes of Dan Ives and others, Lisa.
Well, and it's also been just brand destruction in terms of all of the news that we've heard out of Twitter and just what you spoke about, John, about the spaces that he held and trying to get advertisers to stay with him. Is he becoming toxic to himself and to his company that has been a shining star?
From a strategic, as an amateur on this, from a strategic standpoint, are there like 42 or 47 electric vehicle-like cars competing now with Tesla?
There's a lot of competition coming.
I just don't get it.
And he's been a big part of that, encouraging that competition by the immense success he's had over the last few years. What I don't get about this call from Dan, and I'd love to catch up with him soon, and I'm sure we will. He's always open to these questions.
Show today with Mohammed Al-Arian.
If he believes it's a painful, dark situation, why has he still got an outperform rating on the stock?
Yeah.
He goes on to say at the bottom of the note, we're lowering our price target from 300 to 250, reflecting a lower multiple associated with the Musk overhang that gets worse by the day. If it gets worse by the day, he's still looking for upside here at 250.
Yeah. I agree.
So I wouldn't call this mass capitulation from Dan this morning, but certainly reflects some of the concerns people have about that name.
Well, it's a readjustment, and we'll have to see how we readjust on a daily basis with Mr. Musk. At Tesla, he's only buying companies with the letter T.
Is that right?
Yeah, Tesla, Twitter.
Is that how it works?
Yeah.
Where does SpaceX fit in?
I don't know. Is that a company? I don't even know. Anyways, let's continue forward here. There's 8 themes to talk to Anne-Marie Horton about, and I'm going to touch on the election right now. Anne-Marie, it's really been under the radar, and certainly within our study of economics, finance, investment, it is under the radar, except for the nation, it's not. Whether real or perceived, crime is front and center. Lots of morning after analysis in New York State about how crime was handled by both parties. What is your knowledge, your summary of what you learned about crime in America and this election?
Well, I think New York for the Democrats is going to be really something they need to dig into as a post-mortem. And for the Republicans, it could potentially be a playbook. Because what New York is showing that the Republicans were able to really pick up districts that the Democrats and President Biden won by large margins because they were able to really come out and deliver this message on rising prices in New York City and the surrounding areas and across New York State, as well as the concern over crime. So yes, the governor did end up pulling it out and she won the race. When we look at some of these congressional districts, Nassau County, Hudson Valley, even people voting Republican in places in Queens and Brooklyn. This is something the Democratic Party is going to have to deal with because this is perhaps one of the most, if not the most, liberal states in the United States.
Can there be a centrist aspect to the crime debate on Capitol Hill? Can there be Democrats and Republicans that come together on crime, or is that just unthinkable?
I think it potentially can because the Biden administration and President Biden said yesterday he understands concerns with the electorate that inflation and crime is still a major problem. And these are things that he understands people are concerned about. So potentially, even though it was not the red wave, and the president wants to keep reminding all the journalists in the room that it was not a red wave, that pundits and some polls were predicting, not all polls, but some polls were predicting, that he's going to have to maybe move a little bit more to the center. And he already spoke with Kevin McCarthy last night. So we already are seeing the president do that because these next 2 years, he does want to get items done on Capitol Hill.
Meanwhile, the Republicans perhaps also moving a little bit more to the center in certain aspects. Do you get the sense, Anne-Marie, that more broadly people are blaming Trump for the lack of wins that we saw from Republicans?
A lot of people are blaming the former president for his picking of candidates that they say just didn't have the credibility or the quality to win, especially Senate statewide races. You think of Mehmet Oz in Pennsylvania, and there is a report that the former president is not blaming himself for picking those candidates, even one saying he was putting that blame, no joke, on his wife, Melania Trump. You saw the New York Post this morning with their front page really taking aim at the former president. You see the Wall Street Journal this morning with an opinion piece saying that, yes, there was no GOP red wave. It's astonishing that there was not, given the fact that the party in power is dealing with 40-year high inflation. And they also put the blame on the GOP's pick of poor candidates. And that really goes down to the former president and those individuals he backed.
Well, the former president told us the rules going into this, didn't he, Tom?
Yes, he did.
He told us. You heard them. If we do well, I get the credit, and if we don't, it wasn't my fault.
When do we hear from him? And yeah, I think you mentioned
we'll
earlier that there's a huge push for him to stay out of the dialogue until after December 6th. And I would suggest, John, that's virtually impossible for Mr. Trump.
You know, I watched a bit of Fox News yesterday, Tom, just to get the tone of things, and that's what I heard from a lot of people on there, just kind of pushing the former president to maybe delay that decision.
I like Libby Cantor. We talked to her yesterday.
She's great.
And I thought her note this morning with PIMCO was just brilliant about this is so seismic, this election. We don't even understand that yet, that you go back to 55 days after 9/11 and that election.
I think she called it a red whisper. I think that was her phrase.
Well, that may be the phrase, but I think the ramifications here that Anne-Marie's talking about, the slice and dice of it, is going to be fascinating.
AMH, thank you. Anne-Marie down in D.C. You know what yesterday in that news conference with the president reminded me of? You know when you go into an earnings season, say a print for a big tech company, and the bar's really, really low, and they kind of hop over a really low bar, and everyone's like, yeah, great story. Great earnings story. Yeah. Great earnings story.
You thought it was too positive relative to the fact that they still probably are going to lose the House and potentially still even the Senate.
I mean, we don't know. This whole story could change in the next couple of weeks in Georgia as well in a month from now.
The overwhelming nature of it, though, is considered a win. The low bar, to your point.
The low bar. It felt like one of those earnings stories where it's like, terrible expectations. They beat estimates.
And everyone's like,
the stock rallies, and everyone's like, yes, we don't need to change a thing.
The article I want to see is who are the Joe Manchins for the Republicans in a Republican
House. Interesting.
There's got to be like 5 or 6 of them.
That would be.
They will be powerful.
Futures up. CPI an hour away. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
The top names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive.
But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK.
The market environment is a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority.
CPI data in America 60 minutes away. Going into it, equity futures just about positive, up 0.2% on the S&P. On the Nasdaq 100, up 0.4%. The rest of the year looks a little something like this. CPI this morning, December 2nd, the payrolls report. The 6th, you should get a runoff in Georgia. Then on to the 13th, the final CPI print of the year. Then on to the 14th, the Federal Reserve. And then we can all go home. Looking forward to that. About a month away. Let's get to the bond market. 2s, 10s and 30s. What a year it's been for the bond market from 12 months ago, I'd say in and around 40 basis points to right now on a 2-year. On a 2-year, Friday came very close to 480. At the moment, about 20 basis points south of that number of 459.93. Yields up by a couple of basis points going into this print a little bit later. I think the one we're all watching, though, just one eye on what happens in the land of Bitcoin, Tom, and what happens with crypto. Bitcoin, 12 months ago, pushing about 70K. Right now, let's call it 16.
A lot of questions out there on it, John. And of course, crypto will have a special report here. I believe they're working on that
1 p.m.
right
Eastern.
now, 1
Looking
p.m.
forward
Eastern,
to it.
really expanding out and really trying to explain this, John, to be honest, to people like me who have no clue what's going on.
JP Morgan, Tom, talking about the potential for a cascade of margin calls. And I think we're all trying to work out how much leverage is there and how much contagion can we expect, perhaps even across traditional asset classes as well.
Right.
And that's something we need to probe, get our teeth into over the next couple of days.
John, I'm going to editorialize and say there's way, way too much focus on billionaires or less than billionaires and far less focus on people getting run over by this event.
Couldn't agree more, Tom. There is going to be so much pain for individuals across this country and beyond. And that's the point, Tom, where the billionaires you speak of, they were billionaires.
I just have trouble,
how
John.
much money they've got now, how much hot water they're going to find themselves in over this.
We got to move on, but John, I'll be honest. I've seen the ballet at Davos. It's billionaire adoration. It's gone.
Like that.
Gone.
Let's cross asset price action. Let's get you some single names. We can do that with Lisa. Hey, Lisa.
Hey, John, let's talk about the Bitcoin space a little bit more because there are all of these companies that are tied so intimately to the crypto story, including Coinbase. And I'm watching today, it's going up, but yesterday and the day before, huge losses, up now 1.2%. How much, to John's point, just to build on this idea of the ramifications, the broader acceptance of crypto, investment in it, how much does that really rebound into other asset classes and potentially cause not the failure of other companies, but just some real pain that you start to see expressed in market valuation at the very least. In terms of those that are doing well, Rivian, we were talking just earlier, Tom, about who the competitors to Tesla really are.
Yeah.
Rivian, front and center, the maker of electric vehicles, up more than 8% after reporting faster production than people had been expecting and keeping some of their targets, better than expected guidance. How much do we start to see some of these others gain traction against the likes of Tesla, given how much the technology is advancing and given what's going on right now with all of the controversy around Elon Musk? And Bumble shares lower by 14%. Bumble is the online dating service, Tom.
Yes,
where
I knew that.
The woman has to reach out first, not the man. And that was something that gained traction over the pandemic, now lower by 14% as they post worse than expected earnings. Again, how many things gained incredible market share during the pandemic, gained incredible amounts of money due to zero rates, now struggling as they face a bleaker reality?
We will see in the bleaker reality again as crypto. Look for that special broadcast, all the knowledge Bloomberg has this afternoon, the extended conversation on where Bitcoin is at 16,000, 15,000 here a little bit ago. Kathy Jones now Chief Fixed Income Strategist at Charles Schwab. Thrilled she could join us morning. Kathy, I want to get right to the reality. You know I've been on this. I don't care about spreads. I don't care about fancy convexity and the rest of the Frank Fabozzi world. I'm down 15% in some flavor of quality bonds. How do I begin the recovery?
Well, yeah, there's a couple of choices you have. So, most likely what you want to do is start reinvesting in higher coupon bonds. So, in order to recoup your money, you want that coupon money, right? Because that's what you get out of the bond market. It's much less about capital gains. So obviously that was when yields were falling to zero. But in reality, most income you get from fixed income is the coupon payment. So frankly, to repeat what we had this year and get another 14% down, you'd need rates to go to 9%. Now, I know a lot of bearish people. I don't know anybody talking about 9%. So even in a static or higher interest rate environment, if you have higher coupon paying bonds, you're going to have a positive total return.
What quality of quality corporates is the best positioning point? Is it the no-brainer AAA? I'm not using that as a credit rating basis, but just the emotional AAA quality, or do you want to go some shades of quality down to find that coupon?
Well, in the corporate bond world, there's not a lot of AAA paper out there anymore.
I know that.
But you want to stay investment grade. We think high yield is very appealing at 9% yields. The problem is we haven't really, I don't think, discounted the weakness in the economy that's coming, and there's probably more shakeout there. So pretty cautious on high yield, but sticking with higher credit quality and with munis too. For if you're in a higher tax bracket, the muni market still offers some very attractive tax-exempt returns.
How much are you staying in cash or short-term bonds? I mean, we just heard from Phil Camparelli over at JP Morgan, 10% of his portfolio in cash because there is an alternative. Are you finding the same thing in fixed income and avoiding, for example, long duration simply because of the uncertainty right now?
Yeah, we're seeing a lot of people, stay short, relatively stay short duration. We think that's actually a mistake to stay all in cash, because to lock in higher yields right now, we think is an opportunity. We are looking for inflation to come down. We are still looking at a rocky road ahead for the economy. And if you're not locking in some of that income right now, you're probably going to ride it up and ride it all the way down and be looking at lower yields down the road. So we're not extending duration to, 30 years, but we definitely think you should be moving out to at least an ag-like duration in portfolios.
Do you think that longer term, we're going to see an average 10-year yield closer to, say, 3% or even 2%? Is that the more likely kind of target that you're looking at, just to give people an understanding of the rate of change and where we may be headed?
Yeah, we do. I think some of the basic fundamentals haven't changed. So, we've got some, weakness in the economy coming, just the cumulative effect of all the tightening we've seen globally. We should see the economy continue to weaken and inflation come down. But then we haven't really changed the demographic profile globally and domestically of an aging population. We still have a lot of savings around the world. And frankly, in the U.S., we still have the world's reserve currency that people flock to when things get tough. So I don't know why we wouldn't go back. We get inflation down to around a roughly 3%-ish 10-year yield.
Hey, Kathy, Ira Jersey over at Bloomberg Intelligence just publishes, and he talks about a 10-year yield that will be hovering and that there'll be almost a stasis. Are you assuming we come out of bond volatility and yield volatility towards a hovering sense of the fixed income market?
Well, I would love volatility in the bond market to come down, but I think we have to get the Fed to slow down or stabilize before that happens. I think one of the concerns I have is that this volatility, this rate of change has been so dramatic and so high that it's kind of destabilizing a lot of other things. So, because bonds are used to price other assets, if you have a highly volatile treasury market, you can't really price those assets very well. So I think down the road, sure, we should get lower volatility, but I think we need to see the Fed plateau at least before that's going to happen.
Kathy, awesome. One of the best, as always. Kathy Jones there of Charles Schwab. Tom, 400 basis points in 8 months. 400 basis points in 8 months from this Federal Reserve. And, what did we get in the last tightening cycle across 3 years? Half of that?
Yes, if you're on the right side of this, you're a genius, but I would say that's a very narrow group. And again, not to compare contrast with Bitcoin, they're two different, they're not even apples and oranges.
Sure.
But you've got this idea of a lot of people who face some real loss. And the index, Lisa, to negative 15%, there's not much difference for a bond retiree from negative 6% and negative 15%. They're both equally painful. It's brutal.
It's been a difficult year, and one of the key questions is, when is the 60-40 going to come back? When are bonds going to actually act as some kind of counter-cyclical counterbalance to risk assets? Yeah, there's some people who are suggesting that perhaps the second half of next year, I forgot where I was reading, a number of analysts pointing to then as possibly seeing some sort of counterbalance from the 10-year yield, but we haven't seen it reliably yet.
So yeah, I think you can make that argument now relative to 12 months just for the fact because yields are so much higher. Question I have off the back of 400 basis points of tightening in 8 months is the price you're going to pay for that, a 21% move on the S&P 500.
Yeah.
Is that it? We're done. 400 basis points of tightening and the price you pay is 21% on the S&P.
How do you even game that out when you don't understand what the consequences are going to be of a 5% Fed funds rate? And to that point, this is basically just throwing darts at a dartboard, which is the reason why Phil Camporelli has 10% of his portfolio in cash.
Totally.
I'm not cynical. I mean, I just don't think
all.
so. But I just got an email that the wonderful Dan Ives, who we're trying to effort, is on a plane. And I just wondered if Elon was putting him on SpaceX to enjoy going up in space.
Just sending him back
Elon called up, Dan, we can put you on SpaceX this morning. Stay there.
Stay there. Dan Ives can't join us this morning. That's unfortunate. We'll catch up with him another time, Tom.
And he will publish. And there's a lot to talk about. You know, we haven't talked much about China today, but I think the Apple China update is a great story into the end of the year. Ives is out front on that.
Look, the supply chain risk in China is real and has been for the last 12 months.
You've alluded in the last couple of days, it's come back towards quarantine, COVID, etc.
I just think for Apple it's such a delicate dance because it's a huge production base. It's also a huge source of demand, and do you want to risk the blowback of exiting the country? And I've talked about some unsustainable situations with some multinationals, and we're getting towards decision time.
Well, decision time by who? Is it going to be government regulators that start coming in and saying, guys, not so much? Or do you start to get just the desire to avoid some of the reputational risk?
Do you know who called this election really well? Terry Haynes of Pangea. He's going to join us shortly. Looking forward to that. Terry, the founder of Pangea Policy. Coming up from New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Figures out today are likely to show that U.S. inflation moderated only slightly last month, and that's keeping a fifth straight 75 basis point rate hike on the table for the Fed's meeting next month. Economists forecast that the consumer price index will show a 7.9% increase on an annual basis. The CPI comes out at 8:30 a.m. New York time. President Biden says he still plans to seek re-election and will likely make it official early next year. The president spoke after Democrats avoided worst-case scenario congressional losses in midterm elections. He said the final decision on running again depends on his health discussions and discussions with his family. Well, British Chancellor of the Exchequer, Jeremy Hunt, is considering whether to impose the top income tax rate on more Britons. Bloomberg's learned Hunt is thinking about lowering the $172,000 threshold at which the 45% tax rate is paid. Hunt and Prime Minister Rishi Sunak are looking for more than $57 billion of spending cuts and tax hikes. Analysts say that Meta Platforms' first major job cuts won't be nearly enough to get the company back to being as profitable as it was 2 years ago. The parent of Facebook laid off 11,000 workers Wednesday. Still, revenue is falling, spending has ballooned, and the money saved on job cuts equals just 1 point of operating margin. And it was the largest single-owner art auction in history. In just 2.5 hours Wednesday night, Christie's presided over the sale of just 60 artworks for an unprecedented $1.5 billion. Now, they came from the collection of late Microsoft co-founder Paul Allen. Among them were works from Lucian Freud, Gustav Klimt, and Paul Cézanne. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
This slow return to normal levels of inflation could threaten the stability of inflation expectations. And if there's one thing we learned in the 70s is that the Fed cannot let inflation fester and expectations rise. If we back off for fear of a downturn, inflation comes back even stronger and requires even more restraint.
The Fed speak is back in a big way, and you're going to get a ton of it a little bit later after CPI in America. That CPI print, 42 minutes away. Equities look like this on the S&P 500 going into that print. Just about positive through much of this morning on the S&P, on the NASDAQ as well. On the S&P 500, we are higher by 0.2%. Yields unchanged on a 10-year, just north of 4%. Let's call it 4.1% on a 10-year this morning. Talked about that call from Dan Ives of Wedbush, kind of gives price target on Tesla from 300 down to 250. Yeah. In the pre-market, we're at 177. He added to the call on Twitter. He said this, Tom, we still believe in the long-term bullish thesis on Tesla. That view is unchanged, but this Twitter madness needs to end. Brand destruction is our biggest worry with this Twitter circus show. It's that simple, and I can't ignore it for Tesla stock.
Yeah.
His view.
It's going to be interesting. We're going to move on right now, but I'm going to go to John Farrell here to frame out our next guest. This is important, John, and you alluded to it. What an election to speak to Terry Haynes. He has a certain perspective.
He got it right. He just got it right going into all of this. Everyone was looking for that massive red wave. It dominated the conversations on this show, and that's not what Terry was looking for. Terry Haynes, founder of Pangea Policy, joins us right now. Terry, why don't you start with what you were looking for and why, and we'll take it from there.
Good morning, John. And, you know, I'm kind of old school. I look at the data as much as possible. I weigh in a bunch of other things. I do pay attention to what some of the aggregators are looking at, whether it be, you know, Real Clear Politics or Nate Silver's site or whatever, as kind of a spice. But I've been around this and doing this a long time, and in the end, what you get from me is my own view. I wasn't seeing a wave. I was seeing a slight reddening of the map, certainly, but probably a small House majority, and the Senate's still up for grabs. But I think right now a little more likely to go R than D. But it wasn't going to happen. So what you get out of this is you get continued what you already have, continued fiscal stability. Nothing in the domestic, and continued unanimity on foreign policy.
Terry, will there be a set of Joe Manchins in the House? Will there be centrist Republicans looking to 2024 that will push against more conservative Republicans a la Joe Manchin and the Democrats in the Senate?
Oh, sure. And well, there already are. Manchin by no means is alone. Everybody knows Manchin and Sinema, but I always look at them and know that they're representing others on issues, whether it be energy issues or frankly the regulation of financial services.
Right.
Because remember, they've rejected a bunch of people. Those people exist in the House as well. So sure, these are four factions, not two parties. I always say, and that's still true.
Well, this is really important. I don't think it's in the zeitgeist right now, Terry. It's not a unified GOP in the House. I get that. But do they have real power to steer GOP legislation with a GOP majority in the House?
Well, if they can unify around some things, sure. And there will be lots of responsible people. Patrick McHenry on financial services being one who will look to do that exactly. But it won't be an easy process for them, just like it wasn't an easy process for Democrats in the last cycle. It'll take some time. It won't be instantaneous. And of course, if the Senate does not go, whether or not the Senate goes Republicans' way, you need 60 votes to proceed to legislation in the Senate. They won't have anywhere near that. So the net of that is you won't see very much legislation be successful.
Terry, is it too soon to say that Ron DeSantis is the new leader of the Republican Party?
No, probably not, Lisa. It's probably not too soon to say that. Certainly the direction that DeSantis points, which is, kind of unapologetic on policy, while at the same time having a winning way about him, not only personally but through election results, is exactly the direction the party wants to go in. And so, sure, I think that's probably true.
From a substance perspective, how does that differ from Donald Trump?
From a what perspective? I'm sorry.
From a substance perspective.
Oh, substance perspective. I think how it changes is that kind of consistency of purpose and consistency of message. What always dogged former President Trump was a lack of consistency in messaging and a lack of consistency in substance to some extent. Now he had some successes where he was laser sharp on both of those, China tariffs being one. But a lot of other things, the Trump White House is a little bit all over the map, and that was bad for them. DeSantis has shown in his governorship that he's learned from that.
Terry, Tom's talked about this. I just want to build on it a little bit more to close out this conversation. The failure to embrace mail-in voting on the Republican side. Terry, how do they address that? How do they even talk about it in the coming months?
The what, John? I'm sorry.
The failure to embrace mail-in votes on the Republican side. It just hasn't been part of the strategy for the party. Why not?
Yeah, it's strange, isn't it? They're going to have to, and this is probably a wake-up call for that. I don't know why they've been late to the post on that, but they have been. But they're going to have to figure out that there's really two elections here: the mail-in vote election and the day of vote election. Pennsylvania is a perfect example of that. I could never understand why Oz agreed to debate Fetterman so late after there were so many votes already starting. And they're already in, and that's probably what won election against him.
Terry,
so, yeah, they have to do something different.
Terry, don't feel bad that you didn't understand John. I didn't understand him either there. Like about every fifth word with John, with the accent, I didn't get the mail-in thing there as well. It wasn't just you.
Shall I go home?
No, it's just like a Peaky Blinders thing. I have to watch the captions on. No, I did not understand what John said there, as Terry said the same thing, the accent.
You're suggesting that was a Brummie accent?
No, I should get it here. Now that I think about it, I need to get, the word thing at the bottom of the screen.
Closed captions.
Closed captions. I do that with Pinky Blinders. I mean, I have
He didn't
no idea
understand
what
me
you're saying.
either, and I
Ted
didn't have
Lasso?
an accent.
Well, yeah, but there's a John.
That's fair.
I need closed caption for Bloomberg surveillance with John Farrow. I mean, there's no question about it.
Figuring out how offended I should be.
I think
Right
quite.
now.
I think quite. I think you're justified being quite. But let's talk about shelter.
Mail-in voting.
Terry Haynes of Pangea Policy.
Just
Terry,
hugely valuable. Thank you, Terry.
would you like to take us to break?
No, please.
No, please do.
No,
I'd
please,
hate for
I
people to
insist.
fail to understand my Birmingham accent.
Is that Birmingham? I did not know that.
This
What's the
is-
difference
this is
between a
not
Birmingham and a Manchester
Birmingham
accent?
accent. They sound different.
They're like radically different, right?
Sure, a couple
Seriously.
of hours away, but they sound different, yeah.
Who has a Manchester accent we talked to? Is Jim O'Neill? Is he?
Not really.
This is getting incredibly uncomfortable. Can I just say?
I don't know. But in America, Lisa, we don't have the accent variance. Like, the difference between you and me is not that much. And yet how far is Birmingham to Manchester?
Couple of hours.
Couple hours. It's like another world.
Where are we going with this?
I don't know. I struggled with it like Terry did. I mean, it's okay.
Matt
It's like Ted Lasso.
is going to join us shortly. I might not be here.
Well, we'll see.
I might not be here. I might just
Futures
walk
up
away.
8. Dow futures up 50.
Take us to break.
Oh, no, I can't.
Please do.
Don't do that.
No, please.
CPI, 35 minutes.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Global inflation and recession, an energy crisis intensified by war, and the aftermath of a pandemic. Next week, world leaders meet in Bali for the G20 summit. And Bloomberg is there, bringing you the news and analysis.
A confluence of economic, climate, and security crises make it a uniquely challenging time.
All of these are pointing towards a big slowdown in trade.
It all starts next week, only on Bloomberg, your global news authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
No one covers the world like Bloomberg.
The writing's on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This market is showing that it's discounted most of what expecting.
When it comes to the tightening, the Fed is obviously the most important factor globally.
Everyone waiting for that Fed pivot.
The Fed wants to be more dovish, but will inflation let the Fed, make that shift?
Inflation may have peaked, but boy, the descent is going to be gradual.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, 30 minutes away from an important inflation report that could move markets. John, it's important, and you mentioned on to December, another inflation study before the Fed meeting.
Yeah, whatever we talk about in about 30 minutes' time, I imagine the story could well change going into the Fed meeting. So we have two more prints, one today, one December 13th, and the Fed meeting on December 14th, which comes with a set of projections, and we've got to work out what they think 2023 and beyond looks like.
What's the angst here? How about this? Off the pandemic low on a gallon of gas, we're up 105%, even with a pullback in a gallon of gas. John, in the last 12 months, a gallon of gas, even with a pullback, up 11%.
That's going to be a story for headline inflation for core. It comes down to shelter and the problem that this Fed has. And I think the problem we have following this story is that 12 months ago it was goods inflation. It was the supply side story. It was the pandemic. 12 months later, it spread to services, to shelter. And that's why it's stickier, broader, and slightly more problematic.
And as Terry Haynes just said, Lisa, with the election, it's local and shelter is local. We're all colored by the New York City idiocy. The market here is surreal. But across the nation, there's a surreal element to it.
Local, not just with respect to domicile, but also with respect to income. And what you're seeing, even in the United States, even in New York City, you're seeing the luxury apartments going for bidding wars, whereas the rest of the universe of apartments are languishing. And there's a real divergence emerging, and you're seeing that around the country right now.
Add it up. I mean, it makes out a third of inflation shelter. That's the general guideline. Then you overlay on food, which I think is 8, 9, 10%, whatever that number is. It's a ginormous part of the paycheck.
Honestly, this has been a big issue. We've been talking about how this isn't going to matter until the next CPI print. They won't do anything with one CPI print. So I'm trying to parse out everyone's who's going to trade on this today with all the people who are then going to tell us that it doesn't really matter and that we have to look till December.
Yeah.
But that's really been what happens every single time.
I think that's always the way it is. That's always the way it will be. What we're trying to work out here, more importantly, is we look around the world right now, we can see inflation is rolling over. You can see evidence of it everywhere. You can see the labour market cracking in places as well. We just haven't seen it reach the official aggregate data in quite the same way. And that's the problem.
Let's get to the data check, and I'm going to go to the two-year yield, 4.60%. John, what does the two-year yield do off this inflation report?
Well, it was curious on Friday off the back of the payrolls report. We threatened to break 480 and then backed away. And we're in and around 460 right now. Who knows?
Tick
you can
up,
push the terminal rate much higher than it already is. The Fed has already told you that they're going to go slower but further with Fed funds. And that's my question, really. How much scope is there to push the terminal rate much higher than it already is? You almost need the inflation story to accelerate, I think, to engineer that kind of problem.
I agree with that. The acceleration could be up or down, and what no one's looking for today is a tick up in inflation. I mean, a small tick up in inflation would be big news.
But we've constantly misread this all year. In fact, for the last 18 months. Wrong, wrong, wrong. That's been the story of the year, Tom.
I'm going to start with dollar churning here. I don't think it's just pulled back as much as I'm getting in the zeitgeist here. DXY from what, John? A 112, 113, rounded up. We're back to 111. It's a little bit of a dollar.
Euro dollar's been camped out near parity for the last week or so. It's there right now, 99.45 on euro dollar, negative 0.6%. Futures, Tom, up 11 points on the S&P, up 1/3%.
We'll have to see. That's all there is to it. Joining us now, Patrick Armstrong, Chief Investment Officer, Plurima Wealth. Patrick, what will you look for in 26 minutes?
In 26 minutes, it's going to be the direction of services and shelter is going to be the swing. I think economists have a good handle on where goods prices are. Commodities have rolled over. So it's a little bit harder to forecast, and it creates a bit more of a wild card. But shelter is the biggest contributor and the general direction of non-energy services.
Patrick, help us explore the question we were probing just moments ago. How much scope is there for a higher terminal rate at the Fed, as far as you're concerned, based on what's priced already?
I just can't see it unless the U.S. economy really surprises to the upside next year, because my base case has the U.S. economy slowing, flirting with a recession, probably falling into a mild recession, and that's going to come with job losses that the Fed hikes have created. I don't see how the Fed is going to be willing to keep hiking when joblessness starts rising. So job situation is really robust in America right now. If you do fall into a recession, that's going to change. And I don't see the Fed getting past 5% unless something changes, some exogenous shock that pushes the economy forward. I just don't see that happening.
Are you getting exhausted parsing through all of these reports to try to get some sense of the thesis even going forward, to even craft some narrative for 2023?
Yeah, I think you can get into the minutiae a little bit on each month-on-month inflation print, but you've got to look for longer-term trends. And what's happened is you've seen no deceleration from the services side of things. Shelter keeps going up. Mortgage costs are going up. So if you're a landlord, you want to pass on those higher mortgage costs and rent costs to rent as well. So I think looking for direction and rate of change in those things will be the leader of inflation. And I think the Fed probably does pause before it hits its target, just because as inflation's falling, probably the U.S. economy is weakening. You've got to look at it, but it's the direction of change and movement in the individual subcomponents that matters.
I keep thinking about what Phil Camporelli over at JP Morgan said earlier on the show, where he said that since the summer, he's been building his cash position to 10% of his portfolio, the most he's ever had. Have you been making similar moves since the summer, since we got some indication from the Fed that they were planning for perhaps a higher terminal rate than previously expected?
I've not gone into cash. I love short duration credit, so it's not quite cash, but on BBB plus, single A minus corporate bonds from banks, you're getting a 6% yield to maturity, and I think there's next to non-existent default risk on these big banks, and you're getting a premium to what the 2-year yield is. So cash gives you something now. It didn't give you anything, but I think short duration corporate bonds give you a little bit better bang for your buck, and I'm really attracted to that right now.
Patrick, what is the unlovedness of stocks right now? Exactly how gloomy is the market, and is that an opportunity?
I think that's probably the upside catalyst, and at the end of September, everyone was completely gloomy, and that set the stage for a really strong October rally. I think market sentiments dictated by price, and as the market's risen since the end of September, people are still pessimistic, but probably not as much as they were at the end of September. So I think general pessimism, anything that's bad but not quite as bad as people expect, may be setting the floor under equities and risk assets.
So today, after we get CPI, we're going to hear from Philadelphia Fed President Patrick Harker, Dallas Fed President Lori Logan, San Francisco Fed President Mary Daly, Cleveland Fed President Loretta Mester, and Kansas City Fed President Esther George. Who matters to you? Do you listen to this Fed speak? Does it actually color your view?
Definitely colors the view. They've all got their own agendas and the views on where policy should go. And I think we're going to probably get hawkish rhetoric out of the Fed for the coming few months. They'll really want to show that they've got a handle on inflation, because they know when the economy gets tough, they want to front load things and basically fight inflation now while they can, while the job market's still strong. So even if the Fed is going to pivot, they're not going to talk about a pivot right now.
Patrick, just a final question from me. It's something we've been thinking about more and more over the last couple of weeks. Can you really deliver 400 basis points of hikes in 8 months and then say that the price was just a 20-25% move in the S&P 500? Patrick, I just take a step back from it all sometimes and look at the screens. I'm just wondering where the pain really is. Is this it, or is this the calm before the storm?
I'm cautiously optimistic on equities right now. The multiples, the Fed's destroyed the multiples on equity markets. The earnings outlook is the risk.
Connection lost.
If you can find companies that have resilient profit margins and can defend those profit margins, I'm a buyer of those kind of companies right now. So I like energy, I like luxury companies. The overall index as a whole is going to face a lot of headwinds. There's not going to be massive rallies, but companies that deliver earnings growth, you've already had the multiple contraction, so earnings will drive stock prices.
Patrick, thank you, sir. As always, Patrick Armstrong of Plurimi Wealth. The headwinds at the index level. Lisa, we've had that conversation how many times now over the last week or so?
Yeah,
how many times? Seriously, again and again.
Yeah, well, and this really comes down to tech, right? This really comes down to what we're seeing. I saw there was this one article about how Amazon is the first company to have lost $1 trillion of market value.
Isn't that crazy?
I mean, it built it up over the past 3 years, 4 years. Now it just was taken away in a heartbeat. How much do we see that really bleed into and really create, I hate to talk about the lost decade. People will come out with gloomy,
I think it's fine to talk about that. We should have that conversation. They're not unheard of.
Yeah, I agree.
They exist.
And that's what some people are expecting.
And we've just had a decade of excess in one specific sector, and we've got to work out how quickly it takes to bounce back from that.
Quickly is the key
Got to
phrase.
reshape
Quickly.
industry.
They got to move at light speed.
Media, when it comes to
light speed,
eyeballs, ads, clicks, all of that stuff that Facebook built. Yeah. Are we blowing that up? How far does it go?
I totally agree, John, and the operative word there is quickly. They've got to move at light speed. Jennifer Epstein out with this inflation report in 20 minutes, 19 minutes, John. I am stunned by this. Take out the fancy people. The average rent in Manhattan is $3,850 in the income calculation. To pay $3,850 a month is you need $154,000 in income. That's how twisted this inflation is. Granted, looking at an odd market of New York City.
Well, let's reframe that. Who are the fancy people? Because for a lot of people across this country, if you need $154,000 a year and your rent's $3,850, you're part of the fancy people.
You're part of the fancy people, and we're not even doing that within our Bloomberg article. The other part of fancy is shocking. Top 10% luxury fancy stuff is $13,000 a month.
Still climbing.
Up 13%.
Yeah.
It's surreal. And, you know, we lose scope and scale every day on this.
Well, we're lucky we have you to bring us back down to earth and get us in touch with the common man.
I am.
Matt Lazzetti.
Here we are.
With Deutsche Bank's going to join us next. Live from New York City, CPI, 19 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, the control of the U.S. Senate, it comes down to 3 races where votes are still being counted. Each party needs to win 2 of those states to secure a majority. Georgia, Arizona, and Nevada are still in play. Now, the race in Georgia is headed to a runoff next month. Neither Democratic incumbent Raphael Warnock nor Republican Herschel Walker have received 50% of the vote. Meanwhile, some Republican leaders are moving on from Donald Trump and are embracing Florida Governor Ron DeSantis as the party's best hope for the White House. DeSantis was reelected Tuesday and racked up votes in Democratic strongholds. At the same time, some of the former President Trump's favored candidates suffered humiliating defeats in House and Senate races. The Pentagon estimates well over 100,000 Russian soldiers have been killed or wounded during the war in Ukraine. The chairman of the Joint Chief of Staff, General Mark Milley, also estimates that there have been 40,000 Ukrainian civilian casualties. Milley says that a potential stalemate in fighting over the winter could lead to peace talks. In China, the government has once again reiterated its support for the COVID-0 policy. Still, it's urging more precise and targeted control measures against the virus. According to the state-run news agency, Beijing will try to minimize the impact on economic and social developments. And new Twitter owner Elon Musk has emailed his staff for the first time and warned them of, quote, difficult times ahead. Musk wrote that there's no way to sugarcoat the message about the economic outlook. He also said remote work will no longer be allowed and employees are expected to be in the office for at least 40 hours a week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Gen Z can't seem to get enough of Prada. Loafers, nylon bags, and its Miu Miu micro mini skirt have been flying off the shelves into and onto the arms of young consumers. Fashion tech company Lyst placed Prada second on its fashion index, at its highest ever ranking. So what could be making this over a century-year-old fashion house appealing to a new generation of consumers?
What Prada has navigated adeptly is their overall kind of understanding of how cultural conversations are happening online, their ability to partner with various cultural figures.
Gen Z faces are at the front of Prada's advertising to this new market. Maya Hawke, Hunter Schafer, and Sydney Sweeney will be familiar to any fans of Stranger Things or Euphoria. There could be another factor at play, the environment. Of those surveyed by The Lancet, over 59% of Gen Z said that they were extremely worried about the climate crisis. So, for example, the revival of Prada's iconic nylon handbag using eco-friendly materials may be winning kudos among these shoppers. Of course, Prada and Miu Miu are not inexpensive brands, and as the global cost of living crisis hits, these brands might start to feel a pinch. But, for now, Gen Z seem to be reaching for their nylon handbags and not letting go.
Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think inflation may have peaked, but boy, the descent is going to be gradual, and it's going to be far from steady. I think at the end of the day, you're looking at key components, which are now sort of the cat is out of the bag. They are significantly higher.
How sticky is inflation going to be on the way back down? That was Laura Rain, brilliant as always, the chief US economist at FS Investments. Your CPI print, 12 minutes away. Here's the state of play in the market. Equities marginally higher through most of this morning on the S&P, up 1/3 of 1%. Yields marginally lower, down 2 basis points on a 10-year to 4.07%. And the dollar is slightly stronger against the weaker euro. Tom, euro dollar 99.51.
Let's get right to it here. Again, with futures up 13. Matt Lazzetti joins chief U.S. economist at Deutsche Bank with a really important call on recession out front of so many others. We're thrilled he could join us here for an extended time through this call in 12 minutes. The language is sufficiently restrictive. What will you learn about sufficiently restrictive here in 11 minutes?
Yeah, first, thanks so much for having me. It's great to be actually in person. I think in terms of sufficiently restrictive, we know a lot of the inflation data is lagging. I think that the Fed certainly took account of that in their last FOMC statement, talking about the lagged effects and the cumulative tightening that they've done, and that's kind of an independent condition, I think, when they're thinking about stepping down. I think in terms of sufficiently restrictive, when you look at the economy overall, we haven't seen the labor market really slow materially at all. It's still incredibly tight. The persistent elements of the inflation data remain very elevated. And I think when you look at the U.S. economy, trackers for GDP in Q4 are bouncing back, particularly with auto sales picking up. So I don't know that we're going to learn too much about sufficiently restrictive with this morning's data. I think it's going to take time. That doesn't mean the Fed doesn't necessarily step down in December. But I think we're going to have to see more jobs reports. We're going to need to see more JOLTS reports. And importantly, we need to see what's happening with the consumer.
Why can't it fall as quickly as it rose? That's what a lot of people are asking. What is it about this inflation story that prevents that from happening?
I think the nature of it has just changed incredibly over the past year. So initially it was narrowly confined. It was about a few items, and it was about supply constraint items. So everybody talked about used car prices as being the key driver. Today it is so broad-based. You know, what I tend to look at the end of this day is what is trim mean telling us? What is median CPI telling us? Those are good measures of broad-based inflation, and those have been very elevated. And so I think what you've seen is it's in the services items. We know rent and OER are going to be persistent. Some of these other items within the service basket we also think are going to be persistent. And it's also consistent with a labor market today that is very tight. Unit labor cost growth trend is very negative.
Matt, you know what the next question will be? I think anyway. What would you say to the people watching, listening right now who say, Matt, I'm seeing a different story. I'm seeing layoffs at big companies. I'm seeing price declines in retail because of inventory. I'm seeing freight get absolutely hammered in a way that is just completely divorced from the story of 12 months ago. What do you say to those people?
Yeah, so I think we all expect that we're going to be seeing it in the goods data. So, you know, what I would look for today is, are we seeing household furnishings coming off, apparel? Are we seeing good broad-based goods deflation? I think that's the first indicator that we need to see to get confidence that that's actually going to show up in the inflation data. You know, I think what we've heard from a lot of the companies is consumers are not as price sensitive as they were before. They can still pass through price increases. And I think from the labor market side, you know, I don't want to overemphasize what we're seeing with, you know, big tech.
Sure.
It doesn't represent the U.S. economy. I think when you look at the JOLTS data, certainly the initial jobless claims data, everything looks tight. So it's a labor market that still looks very tight on most metrics.
I'm looking right now at the Cleveland Fed nowcast for inflation, which a lot of people have said has really been dead on consistently. And it still has basically an 8 handle for November CPI. And I'm thinking, yeah, it'll take time, but the Fed doesn't have a luxury of time. And given how slowly it's coming down, is the Fed destined to basically break the back of this economy, because there is no other way to do it other than to raise rates further and hold them there for longer?
Yeah, we think so. I mean, it's a question of what do you think the nature of the inflation data is today? Can we get back closer, much closer to the Fed's target with the unemployment rate only rising to 4.4% as the Fed is looking at? You know, the research that we've been doing suggests no. I think you're going to need to see a much sharper rise in the unemployment rate. I don't think that the labor market can come into better balance simply by job openings coming down. I think the evidence is that as job openings come down across the board, we are going to see layoffs pick up and the unemployment rate rise, and that is the most likely path and the most reliable path, I think, to getting price stability.
Can we tie in the election? I know a lot of people are sort of shrugging it off as a non-event, but it does raise the inability for this government to really create a fiscal response to counterbalance anything. And we've been talking about that for a while now. How much does that affect the duration of the downturn that you're expecting, as well as the depth?
Yeah, I think there's two things. One, we should look at the economy today. There's still a lot of latent stimulus out there. So you look at household balance sheets with somewhere between 1.75 and 2 trillion of accumulated excess savings. We have state and local governments that are actually stimulating meaningfully today. We wrote a piece about at least $30 billion of stimulus checks from state and local governments. And so I think that there is still a lot of latent stimulus. From my perspective, that tells us that the economy is going to be more resilient in the near term. The Fed has to keep raising rates. But then I think you're absolutely right. On the other side of this, if we do get the recession, it does mean that no doubt fiscal policy is going to be less responsive. We think monetary policy is likely going to be less responsive given persistent inflation. And then you have the tail risks about the debt ceiling, and does that bring actually fiscal retrenchment back in? So that's the tail risk that I think the market is certainly focused on.
Do you know how much we like you? We like you so much, we gave you Mike McKee's seat. Mike McKee is about 1 million miles in that direction, and I can just about see him. Morning, Mike. Walk us through the numbers you're going to be looking at in about 7 minutes' time.
Morning, John. Well, we're looking for a slight increase in the headline number, up by 0.4 or 0.6 on the month after 0.4 the prior month, because basically energy. The core, though, is expected to drop a little bit, 0.5 increase from 0.6. Now, those are not going to be great improvements, but I do want to point out that I'm not looking at the year-over-year numbers, because that includes data from 12 months ago. It's what the Fed wants to see is the sequential decline in the month-over-month numbers, and certainly if you're looking at the core, you're not seeing that yet. If we get even a drop to 0.5, that's still a big increase, and it's still something the Fed is going to be worried about, because this would only be the first drop in several months.
20 seconds, Mike, because we got to go. What is the item you're going to look at besides shelter?
I'm going to look at service prices. I think Matt has exactly the right view there. Goods prices are going to come down. Service prices are going to be the real issue. And then we take that apart to see, is there something in there the Fed can actually influence?
Mike McKee, thank you. That's a big debate at the end there, Tom.
Big debate.
Can they influence what we're seeing?
We'll talk to Lizzetti about this later after we see the numbers. The three of us, quickly, what does inflation subside down to? Headline inflation. To me, 5%. That's totally unacceptable.
If we get down to 4 or 5, do we have a different conversation at the Federal Reserve? They're not going to keep on hiking until we see 2. They're going to keep on hiking until they're convinced that we're on a downward trajectory back down towards target. And Lisa, I don't know how much data they need, how much information they need to be convinced of that.
For now, they're going to keep hiking until they get down to 2. What happens if you start to see the dual mandate come into question a little bit more and you start to see unemployment rise to some of these levels? Then do they say, well, you know, we don't want to cause undue pain to the economy and we understand the risks?
I don't think you're going to see that.
They certainly aren't going to message that now.
They're not.
That's not what they want to signal.
I mean,
what they want to signal is different to what they may well do.
You're right about the vector.
That's why it's difficult being long equities at the moment for many people, because this Fed wants to signal such a hawkish policy stance, even into an economy that many people anticipate will roll over. This is Bloomberg.
Names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK.
The market environment is a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
Industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
Inflation data in America seconds away. Going into that data, equity futures up 0.25% on the S&P 500. Breaking down the data for us, let's get over to Mike McKee. Morning, Mike.
Morning, John. Well, it comes in pretty much as forecast, except a little bit lower on the headline number. Headline and core come in lower than forecast. So this is a good report. It's going to be interesting to see how the market reacts. CPI on a month-over-month basis up 0.4, pushes the year-over-year number to 7.7%. That's down from 8.2. The core comes in up 0.3. The forecast was for 0.5, and that pushes the year-over-year to 6.3 from 6.6. So a significant improvement in the data that wasn't expected by the markets. What's interesting is the last 6 or 7 months, the numbers have come in stronger than expected. This is the first time we've seen something that's been actually a little bit worse, a little bit lower than expected. So good news there. What are the markets doing, John? Well, I look at the numbers for the individual categories.
Exploding higher, Mike,
Exploding.
as you might expect. So big downside surprise on CPI, a welcome downside surprise on CPI. Equity markets up 2.5% on the S&P 500. Once I've told you that, you can guess where the bond market is. At the front end of the curve, we're down 19 basis points. On Friday, shortly after payrolls, we had a look at 480, at 479. We're back down to 439. On a 10-year Tom, we're down 12 basis points, 397.
I'll let you do the math, John. I'm going to say this. I have never, and I mean never, seen the equity market futures move like
Explode
that
high like that.
off a first print. I've never seen that lift.
We'll get you the intraday charts up. If you want another intraday chart this morning, just check out any currency pair with the dollar on the other side of it. Euro dollar up 0.6%. So you've got a much, much stronger euro, and across the board in G10, a weaker dollar off the back of this. So downside surprise on CPI, equities up, yields lower, dollar weaker. Mike McKee, you've had an extra few minutes. Break down the composition of this one for us.
Well, it's kind of interesting. We did see gasoline prices rise by 4.4% on the month, which is no surprise. The big declines come in used cars. We finally got that one into the system, down 2.4%. Apparel down 0.7%. That was expected as well. Shelter costs go up by 0.8. That is more than we've seen in the last 3 months. Rent up 0.7, and owner's equivalent rent up 0.6. So housing still contributing, although the owner's equivalent is down a little bit from the prior month's 0.8 rise. Airline fares down 1.1%. Motor vehicle insurance still continues its rise, up 1.7%. So we're seeing the categories that we anticipated, particularly on the goods side, going down. Categories on the services side still rising some. The bad news, and Tom will appreciate this, is it's going to be a long, cold winter, it looks like, in New England, and not because the Red Sox were terrible. Fuel oil up 19.8%.
Yeah.
That is an issue.
Stephen Shork's been brilliant on that for us here, the challenges in the Northeast. Michael McKee, how does this report change the Fed speak Lisa's reported on that we see today?
I don't think it changes it at all, because it is, first you go back to the standard disclaimer in economics of 1 month's data don't make a trend, but it does tell them they're sort of in the right direction. So it sort of underscores the idea that maybe they can take a bit of a, I don't know what the word to use is. I don't think it's a pivot to go down to 50 basis points. That's still a lot.
Step down.
But they could do that step down to 50 basis points. Thank you, Lisa. And they'd be justified in the market's view. And I think that's what we'll see over the next couple of weeks. Now, we got a lot of Fed speak today. So we will get a pretty instantaneous reaction to what's happened.
How much are we looking at the areas that did decelerate or didn't accelerate quite as much as people had expected, that those kinds of decelerations would continue, Mike? I mean, is there a sense of any kind of trend in any of the areas that you've been parsing through?
You can't, that's the problem. You can't really call it a trend. There isn't anything that has been consistently going down, but with the supply chains starting to normalize, we should see that going forward. Food up 0.6. It was up 0.8 the past 2 months. So maybe that's the beginning of a trend, especially with the Ukraine grain shipments continuing. But we're going to have to wait and see for a while on all this. I think you can probably anticipate that goods prices are going to continue to go down. Matt mentioned earlier some of the construction supplies and household goods, furniture and bedding down 1.2%, window coverings down 1.2%, floor coverings down 1.4%. A lot of that furniture comes from China, and so maybe that suggests that we're seeing a bit of an improvement in supply chains as inventories build up.
Mike McKee, thank you, sir. As always, there is a hope this morning off the back of that data point that this is the beginning of something. To Mike's point, December 13th is your next CPI print. A day later, you get a Fed decision and a whole set of projections. This morning, at least, we're backing right away from the idea that the Fed's going to go 75 basis points again after that print, Tom. We talked about equities exploding higher on the S&P by 2.8% now. On the NASDAQ 100, much, much higher off the back of this. And yields at the front end of the curve down almost 20 basis points on a 2-year. So, TK, to your point, when did we last see a move that large?
An explosion. I really can't.
Big move.
In umpteen years I've been doing this, I think I had the third Bloomberg. And when Mike and Tom Secunda made it up, I've never seen that pop. Ever.
Down 20 basis points on a 2-year, on a 10-year, down 15, and the dollar a whole lot weaker.
We're not going to show the chart right now because we don't want to waste a second with Matthew Losetti, chief U.S. economist at Deutsche Bank. But, Matt, I look at core CPI, and you got to be kidding me. This is, to use a fancy phrase that David Folkerts-Landau would use, this is a teens-weens move and a turnaround. There's no way there's a vector here. So on the path, it's 6.3% core. What number do you need to see where you have John Farrow's vector of disinflation?
Yeah, so I think we shouldn't overemphasize the 0.3. We've seen that a few times over the past year and a half. But I think when you do look at the underlying elements of this data, there is some support there. So owner's equivalent rent coming off a little bit. We saw health insurance inflation come down, which was anticipated. You're seeing some of the goods deflation as we were, everybody anticipates that we were going to see. Apparel prices down, used cars, everybody knew was going to be down, household furnishings coming off. So I think the underlying elements of this report are actually, they're good. They're supportive. There's, some evidence that we are moving from peak inflation down lower. Where do we end up, I think, is the big question.
But to John's point on vector 6-ish core inflation, at what point do you say, yeah, the arrow's pointing down? Is it 5.8? Is it 5.2? How much move do you need to see in core to say vector in place?
So I think we can't look at the year-over-year data simply because you're building in all these 0.6, 0.7 prints that we've seen over the past year. I think it's all about the month-on-month prints, and I think the market is right to focus on that. In those prints, we've gotten, I would say, some broad-based deceleration in a lot of these categories. I would expect the trim mean and median measures do look better today. It does support, I think, what is the Fed's leaning towards wanting to downshift in December. And then as we get into next year, February, March, it's all about, can we maintain some deceleration? And will you begin to see the labor market come into better balance over the next several months?
And we're seeing the market downgrade the expectation for a 75 basis point rate hike in December. It seems like a 50 basis point rate hike is being locked in, as well as a lower terminal rate than perhaps they were thinking just a couple of minutes before this report came out. How much does that change your assessment of how far the Fed will have to go if we get an ongoing downshift in the inflation reads, if we get another softer than expected print in December? Does that cause you to rethink, A, a recession, and B, that it's going to be deep?
Yeah, I think the big if is do these continue, because we've seen these 0.3 prints before. But no doubt, if you continue to see these come off, it's certainly supportive for the Fed not having to get to much higher levels. Our terminal rate has been at 4.9%. I think that still seems like a reasonable view at the moment. We wrote a piece yesterday. There's a lot of focus on financial conditions, and certainly with equity markets really taking off here, there will be a lot of focus on our financial conditions easing in a way that Chair Powell does not want. What I would highlight that is maybe a little bit different than that is the bank lending channel. And we get the senior loan officer survey. It's a really good leading indicator when you see tightening of lending standards on commercial and industrial loans, commercial real estate, and we've seen a material tightening there. So it's a question of, has the Fed done enough? How much more do they need to do? The bank lending channel tells us you may not need to have a materially higher terminal rate than what's being priced.
It's a 3% move on S&P 500 futures. It's a 19 basis point, 20 basis point move in some places on the curve in the bond market. Let me ask you this. You said something that is of interest to me. This gives the Fed the space to do what they were going to do anyway, which is back away from 75 basis point hikes. If this Fed had this data going into the last meeting, would that news conference have been any different?
I don't think so. I mean, you know, I think the worry is when you downshift that you ease financial conditions in a way, kind of like what we saw in July, that is counterproductive from the Fed's perspective. This is one data point. We had 0.6 the previous month. This is 0.3. There are some encouraging elements within this data point, so I definitely want to emphasize that. But the Fed needs to see more to say, you know, we can decelerate then from 50 down to 25 and ultimately pause at some point. It is something that I think helps them along that path, but it's not conclusive evidence, I think, that they can peak up at 5% and be fine.
For others watching this and listening right now, they won't just have the hope that the Fed backs away from 75 and goes with 50. And this data, if we get the data like this again on December 13th, it would endorse that approach. They're hoping that the second piece of the communication from Chairman Powell also gets readdressed. So it's slower, 75, 50, maybe 25. He also said higher. Does this remove the risk or help to remove the risk that the terminal rate, scope for the terminal rate to go much higher than where we are priced right now is removed?
As a median.
Up from 380.
Up from 380. But I think he was saying higher than what they had projected as of September. The market went with it and went to 5.25%.
Higher than what we'd priced already.
Absolutely.
Sure.
And so I think there's some context there. He was guiding towards something that was higher than where they were in September, not necessarily something that was materially higher than what the market was pricing at the time.
A viewer just wants to know your view. As we got the CPI report, we got initial jobless claims, and we see the continuing claims ticked up to 1.49 million. How much are we looking at increase in employment rates that perhaps people have not really priced in fully?
Yeah, so on our read, continuing jobless claims are the best real-time indicators of recessions. There's been a lot of difficulty in interpreting that data. At least if you look to the prior weeks, you had seen this uptick take place, but it was only in the seasonally adjusted data. It was not in the NSA data. So I think there's some caution because there's been a lot of difficulty seasonally adjusting the data post the pandemic. But if you continue to see that rise, it is something that tells you the labor market is beginning to materially loosen. And it is the best real-time indicator of recession.
Matt, this was awesome. Going into the print, coming out of it. I hope we can do it again. December 13th, put that in the diary or something. Okay, Matt Lazzetti.
Look forward to it.
Deutsche Bank, looking forward to it too. Picking things up, the epicenter of this move in the equity market actually comes from the bond market. Just a massive move lower in Treasury yields, down 19 basis points at the front end. That triggers a move. And the other point of tension for many of you worldwide is in the FX market. Yields lower, dollar weaker, and look at this move in the equity market. I said off the back of the data, exploding higher on the S&P 500.
And with legs right now, I'd say it's got some oomph to it.
Futures, Tom, up 2.9% on the S&P, and NASDAQ 100 futures, as you might expect with that move in bond yields, Tom. On NASDAQ 100 futures, we're up close to 4%, up 3.75% right now.
Dr. Lazzetti said real simple here, month over month matters. Most of us rarely look at that. If you regress month over month from the peak of 2021, you don't get, John, to 0.3% until early 2024.
Wall Street is hyper-focused on month over month core to look for signs of deceleration.
Yeah.
You need to see another one.
Yeah, exactly. Exactly.
I don't think these traders are waiting for another one. I think that they're moving now.
Or is it just one
December
big short
13th
cover, one big gloom cover?
Is the next stop for this. Jim Bianco of Bianco Research coming up. Victoria Fernandez of Crossmark. Looking forward to that. Krishna Mamani of Lafayette College and Peter Cheer of Academy on crypto. All in the next hour.
Sonali, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I could care less what Bitcoin trades for, how it trades, why it trades, who trades it. If you're stupid enough to buy it, you'll pay the price for it one day. I've also told people that it can trade at $100,000 before it trades to zero. So tulip bulbs traded for $75,000 once, something like that. The only value of a Bitcoin is what the other guy will pay for it.
5 years ago, Jamie Dimon, this was the IMF and World Bank meetings and the IIF talking about Bitcoin. I think we all know that, and he's been very clear about that within his annual letter at JP Morgan. We're going to do Bitcoin now, but Lisa, I got to quickly get on the markets here. Ian Lingen just publishing, looking at a core unrounded basis, 0.272%, which is how you get the market enthusiasm we've got.
Well, the market enthusiasm, just to give you a sense now, it's almost 30 basis points that you're seeing the two-year yield decline by to 4.3% versus almost 4.6% earlier. It's still moving. I mean, it's just a dramatic rethink of how far and how fast the Fed has to go.
It'll be interesting to see a short squeeze analysis this afternoon at 4 p.m. Right now, we're going to look at the short squeeze in Bitcoin going the other way. Sonali Basak joins us here, not so much on Bitcoin, and she'll be with crypto this afternoon, a special event for Bloomberg. But Sonali, I really want to focus here on the humbling nature of this crypto move, this crypto debacle for big Wall Street firms. They have to be shaking in their seats today.
Where does crypto money intersect with real money is the question at the end of the day. FTX, the hole in their balance sheet, as we've reported, is about $8 billion. That's bigger than the size of the entire market value of Robinhood today. So it is a lot of money that is being asked of where is
Okay, but in your world, the split for me is Bitcoin chat, Tether chat, as Lisa talks about, in blockchain. Is blockchain and transactional digital threatened by this Bitcoin price debacle?
Only insofar as the future investment that could go into it. If you think about how many investors were in FTX and other things that went bust this year, Tom, Sequoia had hundreds of millions of dollars tied to FTX. Not just them, billionaires. Paul Tudor Jones's family office, Alan Howard, SoftBank. Analysts are rushing around trying to figure out what the exposure was after Sequoia has already written their stake down to zero. So how much money is left to invest in blockchain after that?
What's your sense in terms of discussing what the shoe that's going to drop next comes from? Is your sense that a lot of the losses have not yet been recognized or offset with sales?
I know Jim Bianco is about to join and John Farrow soon, and one of the things he told me yesterday was dozens of firms will fail on the back of this because they had their accounts with FTX and they can no longer get that money back. Those are potential miners, other brokerages, people, right?
I think that the distinction for the contagion aspect is the individual who is sold a bill of goods with respect to certain crypto stories that are going bust now versus institutional investors who are going to have to sell, who might even have leverage, which triggers some sort of contagion. How much of that story has yet to unfold?
A lot of it, because we don't know how many firms will continue to face pressure on the back of this. One by one, we keep finding out who had accounts. But to your point here, where does the contagion come from and where does it get worse? You talked about Tether. We did see them decouple for a little bit today in the last 24 hours, really. Those are stable coins. Those are tied to the U.S. dollar. Circle, the head of Circle, put out an entire tweet thread the other day.
I have no idea what Circle is.
Another stable coin issuer.
I have no idea what stable coin is. Keep going.
Digital assets tied one-to-one to U.S. Treasuries with custody and Bank of New York Mellon.
Well, can I just ask how much this is really the problem of regulators? Because a lot of people were saying with some of the stable coins that are pegged to the U.S. dollar, show us your reserves, show us that you have the assets, show us that you're real, that you're really an alternate source of this. And regulators were hands off. How much really lies in those hands?
A lot is what it comes down to. For stable coins themselves, that is the most direct link to the U.S. financial system as well as other currencies around the world.
Off our Bloomberg surveillance conversations of the lack of regulation and SEC turf battles with CFTC and that, is this the moment where the big banks get together and dial 1-800-GENSLER and say, would you guys get your act together?
They're probably just saying, I told you so.
Okay, I get the I told you so, but what are we going to do about this? Because we mentioned this, Chanel, I'm sure you missed this. Come on, this is all billionaire gaga chit-chat. Forget about that. Am I right that this morning people are being crushed in this Bitcoin debacle?
It's not just today. And to your point here, it's not just the bankers that are sitting there saying, get a handle on it. The exchanges themselves, if you're a US-based exchange, you are saying money has moved offshore. Binance is not based in the United States. FTX was not based in the United States either. And so how is the US supposed to get a handle on a system where so much of it is not even in the country?
Lisa, put a cork in my mouth. That would be unfortunate what I would say.
You mean like gaga goo billionaires? Is that
No, it's offshore. I have no idea what stablecoin is. I have none of this stuff. I'm going to, full disclosure, folks, I'm going to BIS and Raphael Auer, who's written best on this and saw the whole thing coming.
Well, and a lot of people did, and yet there were a lot of really sophisticated investors that got caught up in it. And that's the reason why people are thinking about the contagion aspect and how this plays out in a bigger level, and why people said that really that was one of the reasons for the big sell-off yesterday and the day before in risk assets and equities, and even didn't really see a bid for treasuries to the same extent.
Real people are losing real money at the end of the day.
Thank you. Lean forward at 1 p.m. this afternoon, a very special edition on Bloomberg. We're putting together our resources on crypto. Shanali Basak will join as well for important conversations here on where are we right now on the path from 65,000 down to, well, with a big market pop here, 16 up to 17,000 on a Bitcoin. So we're looking at that. SPX up 3%, 3.1%. Dow up 777 points. That'll be interesting to see as that has led the way recently. The market reaction, Lisa, let's go to the bond market where there's a readjustment, price up, yield down.
Right, you're seeing people basically price in fewer rate hikes and a lower terminal rate as
to see is that has led the way recently. The market reaction, Lisa, let's go to the bond market where there's a readjustment, price up, yield down.
Right, you're seeing people basically price in fewer rate hikes and a lower terminal rate as a result of the softer than expected CPI print. I'm looking at the 2-year yield coming in more than the 10-year yield. I find this interesting. Does this start to lead into people feeling the Fed will pull back and allow inflation to run higher for longer? And ultimately, it almost matters less when you start seeing below, and this is something you've talked a lot about, Tom, you've been great on it, going back to 5%, going back to 4% inflation. Where is it okay and livable?
I didn't get much
and not
clarity.
The forefront?
I'm glad you bring this up. I did not get clarity on this today, Lisa. I did not get clarity on how we move forward at a 5% core, 4% core, 3% core. I'm going to suggest 99.9% of the Fed's going to say 3% core inflation is not acceptable.
They're all going to say that because they don't want to give it any other message, but the market might be pricing something different. And so I am watching the longer end. Do people start to move away from this idea that we're going back to that 2% level for a long time because of a lack of conviction by the Fed to stay high for a very long time?
And with the gloom out there, somebody holding 10% cash, we heard today, I am going to get into the healthy nature of a short squeeze where everybody goes, oops, and it's an oops rally today.
Which is the reason why all of the economists say you got to wait for a couple, and traders are saying, nope, not going to do it, bunk. And that's the reason why you're seeing things like you fly, certainly in the equity space.
I mean, triple leverage all cash, you miss these up days. I mean, that's all there is.
Miss the down days, miss the up days.
3874 on the SPX, Dow 33,315. The VIX with a vengeance. Wow, there's a wow statistic as we continue to move to the market opening. The VIX 23.81 in 2 big figures. That is a lower inflation big move. Stay with us. Don't forget our crypto event at 1 p.m. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Global inflation and recession, an energy crisis intensified by war, and the aftermath of a pandemic. Next week, world leaders meet in Bali for the G20 summit. And Bloomberg is there, bringing you the news and analysis.
A confluence of economic, climate, and security crises make it a uniquely challenging time.
All of these are pointing towards a big slowdown in trade.
It all starts next week, only on Bloomberg, your global news authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. No one covers the world like Bloomberg.
The writing's on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Well, that right there was the right kind of downside surprise. Live from New York City this morning. Good morning, good morning. For our audience worldwide, when was the last time you saw some price action like this? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, inflation in America.
The CPI number.
CPI. CPI.
Happy CPI Day. The underlying elements of this report are actually, they're good.
CPI is the number one thing the Fed is focused on.
It's been a recurring nightmare for investors.
The Fed is really laser focused on the inflation readings.
There is no Fed member that wants to go down in history as losing the fight on inflation.
It's going to tell us whether that December meeting is 75 or 50.
It does support, I think, what is the Fed's leaning towards wanting to downshift in December.
Inflation has been very, very slow to come down.
Boy, the descent is going to be gradual.
There's, some evidence that we are moving from peak inflation down lower.
The near-term risk is about Fed. It's about inflation.
We're getting some deceleration, and this equity market is absolutely exploding. Joining us now to discuss, Jim Bianco of Bianco Research, Krishna Mamani of Lafayette College. Jim Bianco, the floor is yours, sir. What do you make of this one?
Well, on one respect, it shouldn't come as a surprise that inflation has peaked. I think everybody understood that. And I think the bigger discussion that we need to have is how far down is it going to go? Is it going to bottom out at 2% or something above that? I'm in the persistent camp. It's going to bottom out something before that. But as far as today's action goes, Jonathan, we're only a couple of weeks away from the one-year anniversary of when Chairman Powell said we need to retire the word transitory. We've never retired the word transitory. Most of Wall Street still believes that this inflation is transitory, or the Fed's got to pause, or they got to pivot, or they got to step down, or whatever variation we want to use on that. And this is only the third time in the last 20 months that the inflation number has come in below expectations. And this is what everybody's been hoping for. So you can see the jubilation and the incredible move in the markets right now. But after we look at today, we're going to have to ask the question, do we go all the way back to 2%, or do we go back to 3.5% or 4%? Because if we go back to 3.5% or 4% and stop there, then the Fed's not done.
Let's go through this with purpose. Jim Bianco, we've got a 20 basis point move at the front end of the curve at 437. In the equity market, the S&P 500's up by more than 3%. The NASDAQ is like +4 right now. Jim, have you ever seen a move like this off the back of a single data point in America?
I don't think I can recall ever seeing from one trade to the next a 2.5% up move in the stock market on the futures contract like that. I've never really seen it. And it just goes to how focused and how important this data is. This is the most important event of the month right now for all financial markets, is the release of the CPI report.
Krishna, I know you're itching to jump in. It's all yours.
Well, so I take the other side of what Jim was just saying. I don't think, based on what Jay Powell was saying in his presser, one could conclude that in the judgment of the FOMC, which is what matters more than anything else, that inflation had peaked. That's why we had price terminal rate meaningfully higher out of the press conference. So I think there are people who were hoping for this, but I don't think that's what the FOMC was hoping for, and therefore it is a total surprise, and it is definitely a welcome surprise from their perspective. The real question is, will this persist? This month, a whole bunch of things came together, and to Jim's point, it is quite probable that we probably don't see this trend continue, and we may actually see a bit of a reversal.
Well, Krishna, you're both asking the same question, aren't you? And the same question is, basically, where do we bottom out? A few months down the road, a few quarters down the road, Krishna, where are you thinking we bottom out? Do we get stuck at 3, 4? Is that the conversation, the thought, the debate that you're having?
Yeah, so I think the bottoming off will probably be more like the first quarter of next year rather than the fourth quarter of this year. Again, as I said, a whole bunch of things came together. This is a good number. It indicates where we are headed. However, looking at it and running with it in full form, I don't think is really the right thing to do.
Jim Bianco, your reaction?
Yeah, no, I think that it really is a question about, where we are going to bottom, and that is going to really drive the Fed. And that's going to drive really the debate now. The debate is I know everybody focuses the debate on December and whether or not we're going to move 50 or 75 in December. It now looks like 50, and the market's overwhelmingly pricing that in. But where is the terminal rate going to be? I still think if we have a sticky, persistent inflation problem, the terminal rate is still going to be around 5%. Maybe it's not going to be 5 1/4. It might be 4.75 to 5 as opposed to 5 to 5 1/4. But it's not going to go down to 4 or 3, and we're not going to, get the Fed to have some kind of a major change unless we see a lot of collaboration in this data, and that means weaker payrolls, weaker earnings, weaker GDP to fit with a narrative that the economy has seriously decelerated. We don't have that. Lost in today's debate right now is, that the initial claims number was actually okay at 225,000. So that's still historically a very low number. And so we're not seeing any evidence from that there's a problem in the labor market.
Jim, I want to pick up on something you just said and compare it to something you said a little bit earlier. We're doing more than just pricing in 75 to 50, aren't we, with a move of 3% in the equity market and a move of 20 basis points lower right the way through the curve. That's more than just pricing out 75, isn't it? We're pricing something else in for next year, it feels like.
Yeah, I agree. I think, go back to my original comment, the vast majority of people still think inflation is transitory. They still think the Fed is overdoing it. They still don't understand why Jay Powell is being so hawkish and becoming Volcker 2.0. And they're looking at this data and saying, this is it. The Fed's going to stop, and maybe next year they're going to start cutting rates. We're going to turn the printing presses back on, and we're going to go back to 2019, and it's all going to be okay. That's really what the hope is in this market, and today's number fed right into that.
Big move in the equity market on the S&P up 3%, yields lower on a 2-year by 21 basis points. Yields lower right the way through the curve. On a 10-year, we're down about 17 or 18 basis points. So yields down, equities up. Guess what the dollar's doing? It's a whole lot weaker. Euro dollar reclaims 101.18, that currency pair with a 1% move higher. Mike McKee, you've had about 36 minutes to go through this one. What do you make of it?
Well, in general, it's good news. You look at the headline numbers and we see that they came in better than expected in every category. The numbers that really matter to the Fed are the monthly changes, and there we saw the headline numbers drop to 0.4 for the headline, and the core drops to a 0.3 move, and it does start to show maybe the beginning of a sequential decline. Now, what moved is also important. Gasoline was up by 0.4 after dropping by 0.5% last month, by dropping 5% last month, and that was to be expected. But food at home drops, owner's equivalent rent is lower, used cars are lower, apparel is lower. Goods prices in general are falling, and that's what really drove the number down. Now, the bad news side is that services prices are still rising at an increasing pace. So that's what's going to have to turn around for the Fed to get where it wants to go. We do have a lot of Fed speak today. We'll get some interesting reactions to that. We can see here the pricing for the December Fed meeting. It's dropped to basically almost a 1/4 point, not just a 1/2 point, but below a 1/2 point. We'll see where it goes from there. The terminal rate that Jim Bianco was talking about is at 4.88 in May. So that hasn't dropped a lot from 5%. That would imply a 5% rate. The first Fed official to speak after the number came out is Patrick Harker from Philadelphia. Now, he's saying that he thinks PCE inflation, which runs lower than CPI, is going to be at 3.5 by the end of next year, which would be appreciable progress. And he says this: In light of the cumulative tightening we have achieved, I suspect we will slow the pace of our rate hikes as we approach a sufficiently restrictive stance. But I want to be clear, a rate hike of 50 basis points will still be significant. And he goes on to say, we also need to recognize this will take time. Inflation is known to shoot up like a rocket and then come down like a feather.
Mike McKee, thank you, sir. That's quite a quote. That's Harker behind us. Then you've got Logan, Daly, Mester, George all lined up to respond to this and I guess respond to what's happening with Fed policy into next year as well. Krishna, we need to talk about consequences. We've had 400 basis points of tightening basically in 8 months. That's a lot of tightening in a very short amount of time. Now we need to talk about consequences. Is the price we're going to pay for that a 25% move on the S&P 500? Was that it? Or are you looking for more?
Well, so again, as I said, whether this trend persists or not is really going to be the driver for this. But I think going back to a point that Jim was making, the difference, or at least the impact, is really not whether we moved much on the terminal rate today. I think the impact really is we are pricing out the likelihood of terminal rate at 6, 7, 8%. We are basically capping the terminal rate. If that's the case, I think there's a good case to be made that we have probably seen the bottom of the equity market. Again, for that to be the case, the trend in inflation has to persist. That remains to be seen.
Jim, your thoughts?
Yeah, I mean, the terminal rate probably is getting capped out at around 5% right now, and there's been talk earlier this week that it might be going somewhere higher, like to 6 or 7, as Chris just said. But I do think that we need to, and I'm going to agree with you, we need to see some kind of a massive deceleration in the market, in inflation, in order to say that the equity market is bottom. Now, we've got one good number, as I mentioned before. It's only the third time in 20 months that we've gotten a good number. Let's see if it gets followed through in the data over the next 2 or 3 months, whether or not that it supports this idea that the Fed can just raise rates 50 basis points a couple of more times and then they can pause for the rest of 2023.
Well, here's the runway for the rest of 2022. December 2nd payrolls, December 13th CPI, the Federal Reserve meeting December 14th. For those of you interested in the politics, I believe the Georgia runoffs are slated in for December 6th. Jim Bianco, there'll be a lot of people writing stories today about so-called soft landings. What would you say back to them?
It's too early to say whether or not we've had a soft landing. What we've had is we've had one good number on inflation, and we have yet to see a turn in the data, especially in the labor data, and I'm thinking about the payrolls report, to suggest that we've actually started a soft landing just yet. So it's still very much an open question as to whether or not we're actually going to get one.
Krishna, final word on that.
I think the likelihood of soft landing has gone up meaningfully. If you get this sort of inflation data, while the growth outlook is actually remaining relatively strong, that's what you need for a soft landing to come about. So the probability is meaningfully higher. I disagree with Jim on that count.
Krishna Mamani, Jim Bianco, sticking with us. Equities right now up by more than 3 percentage points. Coming up on this program, more good news for President Biden.
Press and the pundits are predicting a giant red wave. It didn't happen.
That conversation up next.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
While the press and the pundits are predicting a giant red wave, it didn't happen. And I know you were somewhat miffed by my obsessive optimism, but I felt good during the whole process.
And there was a little bit of a victory lap from the president yesterday. Good news for the Biden administration. The latest inflation data showing slower pace of price increases, and Democrats delivering better than expected midterm results, with the Senate still up for grabs. Joining us down in D.C. is Bloomberg's Anne-Marie. Morning, Anne-Marie.
Good morning, John. Really a sigh of relief, I imagine, for the White House. Of course, inflation north of 7% is still way too high for any politician, but it's the lowest it's been since January. So the Biden administration, we're waiting for what they have to say on this inflation report, but clearly this is a sign that things are moving in the right direction. And yesterday, when the president came out to talk about the midterm election results and really just, really wanted to rub it into the press in the room, saying that maybe we were miffed and didn't believe his optimism. The fact of the matter is he brought up inflation. He said he can't guarantee that they're going to be able to get rid of it, but he did say things were moving in the right direction, and he pointed to the likes of gasoline going down.
He's going to the G20 in a very, very different mood. AMH, you're going to cover that for us, and I think we're going to catch up with you a little bit later this hour as well. Looking forward to it. AMH down in D.C. Julian Emanuel of Evercore wrote a fantastic note yesterday evening. I picked out a quote, but we're going to talk about something else he talked about. Here's the quote for him. The uncorrelated outcomes of elections across the U.S. reinforce the idea that, much like stocks in 22, voters prefer governance and local issue alpha over political party big picture beta. He went on to say election integrity rhetoric likely moderates a win for everyone. That was Julian Emanuel of Evercore. He also talked about crypto and contagion, and I want to have that conversation right now with Jim Bianco and Krishna Mamani. Jim, walk us through what you're seeing in an asset class that you've followed more than most, and the prospect for contagion from your perspective.
I think the prospect is very high for contagion. FTX is an offshore exchange. It's the second largest in the world. There are hundreds of thousands of accounts on that exchange. That includes institutional accounts. That includes the treasuries of crypto protocols. That includes hedge funds. That includes other brokers. That includes institutional investors, miners, validators. Their money is trapped on that exchange. They need to be able to access their money because they've got obligations they have to meet. They've got counterparties they have to satisfy. If that exchange does not reopen and allow them to have withdrawals, then they're going to fail to their counterparties. Their counterparties are going to fail to their counterparties. Crypto protocols, especially those that were tied up with FTX Ventures, that raised money, have their money in FTX accounts, they can't access it anymore. They can't pay payroll. They can't do anything with it. So if this exchange cannot reopen, it's the impact, the knock-on effects are going to reverberate all throughout the entire crypto space, and it might even start to leak into the traditional financial space, especially the tech space. We've already seen that Sequoia has written their $100+ million investment down to zero. There'll be other things along those lines as we move forward if this exchange cannot reopen.
Jim, can you help us understand the numbers here and the depth of institutional adoption that you think is of concern when it comes to contagion through traditional asset classes like the ones you just talked about?
In total, it is estimated that there's about $40 billion of institutional money that has come into crypto protocols in the last 10 years. 25 of that came in last year. That's money that's investing directly in these protocols, not buying coins. That's a different story. A lot of that money has been lost. A lot of that money was in the Terra Luna blockchain. It was in FTX. It was in Celsius. It was in Voyager. It was in BlockFi. These are all exchanges and protocols that have failed this year. So a lot of that money has not just had a bad year, it's gone to zero is what's happened. And so this is going to probably cause a review and a rethink as to how one should be investing in this space as we go forward.
Krishna, how are you thinking about this situation?
Well, so I think Jim makes a good point. That is, FTX failure certainly will have a contagion effect. I wonder if the magnitude would be of the level that he's talking about. That is, the institutional investors, especially VC investing in the space, really has been very, very aggressive. So certainly there is going to be a meaningful markdown of those types of valuations. But I don't think this is really saying, it would be appropriate to say that all of that is basically going down to zero. I think there are lots of protocols, lots of work that will probably persist even after we go into a relatively cold winter for crypto per se. I think this definitely puts takes the oxygen out of the atmosphere, but it doesn't really get it down to zero, or we are not in a vacuum any longer.
Well, Jim, how cold do you think that winter's going to be? And I guess the question I'm asking is how deep do you think the scars will be for this asset class, given what it's gone through over the last 12 months?
Oh, I think that the scars are going to be deep because what they've been relying on, in the phrase we like to use there, is building. We need to build new protocols. We need to build new opportunities. And in order to do that, you need money from VCs. You need money from outside investors to come into the protocols. That's what would drive the idea that cryptocurrency coins would go up. Well, that's what's really been hurt a lot, as we've seen this year. And so if you're looking to raise money because you've got a better idea on a crypto protocol, it got a whole lot harder in the last 3 or 4 days than it has been. And a lot of people that might even give you money have gotten so many losses that they might not even have the capacity to give you money anymore. So no, will crypto get through this? Yes, crypto will get through this. But this is going to be a very tough slog. And crypto's seen this before in 2016 and 2019. It can get very, very dark before the skies break and things get better.
Well, it's certainly dark now and it's getting darker. Jim, great to catch up with you, sir. Jim Bianco, Krishna Mamani, to the both of you. What a move we're seeing in this market, away from Bitcoin at the moment, which is trading at about 17K right now, down from pushing 60, 70, 12 months ago. The S&P 500 is absolutely ripping, up by more than 3%. In the bond market, yields lower by about 19 basis points. And the dollar in this FX market is a whole lot weaker. With some breaking news just moments ago. Here's Abby.
Indeed, John, and related to everything that you all were talking about in the terms of the possibility of crypto contagion and that liquidity crunch, the dark web, we just had breaking headlines around the FTX CEO tweeting that Alameda Research is winding down trading. They aren't doing any of the weird things that I see on Twitter, and nothing large at all. And one way or another, soon they won't be trading on FTX anymore. This, of course, is FTX CEO Sam Bankman-Fried, also owner of Alameda, an embattled crypto proprietary trading and venture capital firm. It's gone dark. There have been several reports this morning about the fact that it's going dark and that they're no longer trading crypto. But here we do have confirmation of that from the FTX CEO, Sam Bankman-Fried. So this story continues to go on. It'd be interesting, John, of course, to see how far and wide it continues to go.
Abby, thank you. Got some coverage coming up a little bit later for you. Shanali Basak, a Wall Street correspondent, is going to break things down for you piece by piece. Peter Chi of Academy is going to weigh on this potential for contagion as well, from crypto through traditional asset classes. Right now, we're absolutely ripping. If you're just tuning in, big downside surprise on inflation in America, and this market explodes higher. On the S&P 500, up by 3.6%. Coming up the morning calls, and later on a rip-roaring rally, we'll catch up with Victoria Fernandez at Crossmark in about 7 minutes' time. This is Bloomberg.
expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Eastern Time, CPI comes out and you just get a massive green light to buy. On the Nasdaq right now, up by 4.7%. On the S&P, up by 3.63 percentage points. Unreal move. That's the price action. Let's get you some morning calls. First up, UBS downgrading Altria to sell, saying investors remain overly optimistic about the company's outlook as consumers start opting for cheaper products. Next up, Loop Capital upgrading Palo Alto to buy ahead of earnings, expecting the company's strengthening enterprise business to drive next week's results. That stock up by 7.5%. And finally, Wedbush removing Tesla from its best ideas list. Dan Ives expecting Elon's Twitter tobacco to weigh on shares at least until new deliveries hit in January. That stock, though, this morning is flying. This whole market's flying. Up next, stocks roaring higher on that CPI print. Crossmark's Victoria Fernandez saying to sell the ribs and buy the dips. That conversation up next. Your opening bout just around the corner.
More activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
What a move. Let's not rush this. 20 seconds away from the opening bell. When was the last time you saw a market like this? Intraday. On the S&P 500, futures up by 3.7%. On the Nasdaq 100, post CPI from an hour ago. On the Nasdaq right now, up by 4.9%. There's your opening bell. Switch on the board and take a look at the bond market. The move's just as large. Yields down by 18 basis points on a 10-year, 391.56. On a 2-year, down 20 to 437. Last Friday, after the payrolls report, we had yields very close to 480 on a 2-year. Now all the way back down to 437 and down 21 basis points on a session. Once I've told you that, you can guess where the FX market is trading. The dollar is trading a whole lot weaker. Euro dollar 101.47. That currency pair up by 1.3%. And crude not doing a whole lot. 85.60 on WTI. We're negative by 0.2%. This equity market absolutely ripping. 30 seconds into the session on the S&P 500 up by 3.6%. On the Nasdaq up 5%. A big boost to big tech post CPI. Here's Katie Lights.
Yeah, John, big tech loves this cooler inflation, probably because it is sending yields dramatically lower on the intraday basis. The 10-year yield is down something like 18 basis points today, and those lower borrowing costs do help hire multiple companies, the likes of Apple, Amazon, Tesla, NVIDIA, all getting massive, massive lifts at the opening bell here in New York. Apple up 5%, Amazon and NVIDIA up 8 and 7% respectively, and Tesla is getting a lift to the tune of about 7% as well. The thing about it, John, though, is this is just one single day, and yes, we may have yields dramatically lower on the day, but still, we're up 240 basis points on a year-to-date basis on the 10-year, so longer term borrowing costs are still a lot higher than they were a year ago, which is why we have seen the valuations for these companies come in so dramatically this year. And what that means is all these heavyweights are less weights than they were in this equity market. In terms of the S&P 500 and the Nasdaq 100, the Nasdaq 100 index share of S&P market cap has been steadily declining. And of course, that isn't just because of a big macro narrative. Their fundamentals have suffered too. Their earnings getting hit by inflationary pressures and the waning demand that has resulted from that. So because of that, the tech sector was the 4th worst performing among major S&P sectors in the 3rd quarter in terms of earnings growth. Actually, earnings were down about 3.3% on a year-on-year basis. And then in communication services, which of course houses Alphabet, aka Google, and Meta, aka Facebook, that was even worse. Profits in that sector down 21% in the 3rd quarter. So it has been a brutal road for tech, John. They're just getting some relief after that cooler CPI this morning.
Just massive moves, Kaylee, and great work as always. Let's go through it together. If you're just tuning in, where have you been in the last hour? CPI 60 minutes ago. The estimates for headline year-over-year inflation were anywhere from 8.1% at SocGen and others to 7.8% at Goldman and others. Year-over-year headline came in at 7.7%. This market, Wall Street, very focused on the potential for deceleration in core month over month. That's exactly what we got. Downside surprise there too. So equities roar, ripping, explode off the back of that. On the S&P right now, we're higher by about 3.5%. If you close the market right now, that would be the biggest one-day gain going all the way back to April 2020. Major moves in equities, big moves in the bond market too, down by 21 basis points on a 2-year, 437. Katie talked about the rest of the year. I'll go through the dates. For the politics, the Georgia runoffs, they're slated for December 6th. For the market, December 2nd on the payrolls report, December 13th for the CPI report, December 14th for the Federal Reserve. That's when you get the projections for 23 and beyond, and we're going to have a much bigger conversation about how far this Fed needs to go. Avoiding recession hinges on how far is far enough for inflation to fall. That's the view from Crossmark's Victoria Fernandez writing this. The problem lies in whether the Fed will be satisfied with 4 to 5% inflation and take that deeply desired pause. If not, and 2% continues to be the goal, then we will continue with more rate hikes and will likely push the economy into recession in 23. Victoria joins us right now. Victoria, I'm going to go back to that quote in just a moment. Let's just start with your reaction to that data an hour ago.
Yeah, I mean, Jonathan, I'm really kind of shocked that we're seeing such a huge response. I mean, especially when you look at the NASDAQ, you and Kaylee were just speaking about that. the fundamentals in those companies really haven't changed. Yes, when they do their discounted cash flows, that's going to be a little bit different. They're long duration stocks, so I can see them rallying a little bit. But 5% when we still have demand that's been pulled forward, you still have restrictions in regards to chips being exported, all of that. I'm really kind of surprised we have seen such a strong rally. We did expect inflation to come down a little bit. And as you mentioned, month over month is key. That's what the Fed's looking at. And you look month over month, a big component of that was used car prices and apparel. We expected that as well because supply chains were doing better. So I'm glad that we've seen the month over month numbers come down. I'm surprised that we're seeing such a positive move in the markets. I would expect we're going to give some of this back, if not tomorrow, probably beginning of next week.
Well, Victoria, let's break it down then. As always with data, you can learn something from the data and you can learn something from how the market responds to it. What do you take away from how the market's responding to it this morning?
Well, I think we're getting a little bit over our skis, and we've done that before. This is what our third, what I consider a bear market rally so far this year. We still have a Fed funds rate that is 250 basis points below inflation. So if you're telling me this is the all clear sign, I'm just not agreeing with you on that. I think we still have a lot of volatility to go. I don't think the Fed is going to stop because of this one number that we see. And you and I have spoken before about the oil and the energy component that we see going for the rest of this year. Remember, there's still European sanctions to go into place in December, along with all the other December items that you mentioned. So yes, we have a decent economy, in my opinion. You've got consumption still there. You know, I love watching the consumer, and the consumer is still strong, but I think there's still a lot of volatility, and I'm not sure that we're ready to ring the all clear bell yet.
Piece by piece then, equities up big time, the S&P 500 really rallying in the bond market, treasuries rallying big time, yields are much lower, down by 22 basis points, the dollar showing a whole lot of weakness. Victoria, as you look cross asset this morning, right now, what do you fade, what do you go with?
So we would be fading any of those names in your equity portfolio where you're a little bit overweight. You want to trim some of those names, take some money off the table. We have been extending duration in the fixed income part of our portfolio, so hopefully you've been doing that as well. If you're an investor, and increasing some of that duration there, because we knew yields were getting close to peak. If you're going to say terminal rate is somewhere around 5%, then peak 10-year rates were going to be somewhere around 4.25%, 4.30%. And we've hit that. 2 years around 475, 480, we've hit that. So I think you can expect duration to start, or yields to start coming down like they did today. Maybe we go a little bit further, but I would be extending duration in fixed income, trimming on the equity side.
So I think a lot more people getting a lot more comfortable with the idea we've seen the bulk of the rate hiking cycle. I get all of that. So let's talk about the consequences. 400 basis points worth of tightening, there and thereabouts in 8 months. The consequences of that, Victoria, are we starting to see it now? And have you seen enough reaction from the C-suite that makes you say, okay, they're taking it seriously, they're resizing, readjusting, and I'm ready to buy? I'm thinking of Meta cutting 13% of the staff. I'm thinking of Snap cutting 20% of the workforce. Are you seeing enough of that to say, I think we're making the adjustment in C-suite and in corporate America?
So I think we're going to be looking, when we look at earnings for fourth quarter, we're going to be looking for a little bit more of that. Yes, we've seen valuations come down, especially for some of the defensive names relative to some of the cyclical names. So I think you can start nibbling, Jonathan, on some of these when we have pullbacks in the market. I wouldn't do it today, but when you have some pullback to go in and add to some of those names, I wouldn't go full on in tech. I wouldn't go full on in any sector at this point in time. You know, we've been very defensive and we were adding value for the majority of the year. We're now starting to say, okay, we've seen that cash yield come down on defensives closer to the risk-free rate. So earnings expectations on cyclicals are starting now, because of things we've heard from the C-suite, are starting to stabilize. So maybe that's where you start to add a little bit in your portfolio.
Is housing part of that story, Victoria, or is it still too early?
So, you know, you talk about things having to be broken, and I think the housing market has been broken, and it's probably at the bottom. We saw mortgage applications actually go higher last week, which is a little bit surprising because the 30-year mortgage rate actually ticked a little bit higher as well. But I think maybe that could be an opportunity that you can look at. We actually added a little bit of Home Depot and a little bit of Lowe's to our portfolio over the last week and a half or so, because we do think you'll see some benefits there going forward.
I just want to ask you about the soft landing debate, because that's going to be the debate going into the weekend. Is there anything in this, Victoria, that gives you comfort, changes your mind about the trajectory for this economy?
I wouldn't say it changes my mind, Jonathan, but I would say, you know, a month ago I would have told you a soft landing was a unicorn of an idea. I don't think it's as much of a unicorn now. I still think the Fed is going to continue to push. They say they're going to look for the lag effect going through the economy, but I think they're going to continue to push because they're not going to be satisfied with a 7.7% headline CPI or a 6.3% core. They're going to keep pushing, and I think that's going to lead us into a shallow and short recession next year.
Victoria, I asked this question of Jim Bianco and Krishna Mamani maybe 20 minutes ago. Let me ask it of you. This feels like more than just repricing the December meeting, taking it down from 75 to 50, when you see moves of more than 3% in the equity market and moves of more than 20 basis points lower in the bond market. Victoria, what do you think we're pricing in here?
You've got to be cautious here, Jonathan. I just don't think Powell is ready to make a move. And you can define pivot however you want to define it, as a pause, as not, you know, hiking as quickly. But I think he's going to continue down the path that he has laid. I think we're still seeing at least 50 basis points in December and a couple of 25 basis points in the beginning of next year. I don't think we're getting a pause here yet. So I think people need to be cautious on these knee-jerk reactions in the market and acting on those.
Seeing some big moves. Victoria, what a morning to catch up with you. Thank you. Victoria Fernandez there at Crossmark. Up by more than 3% on the S&P, up by more than 4% on the Nasdaq. Some of the biggest moves we've seen going back to April 2020 in the bond market. Major moves there as well. Down 20 basis points right the way through the curve from 2s out to 10s. On a 10-year, down 21 basis points to 387. On a 2-year to 434. Let's break this one down just a little bit more and get some movers off the back of this. Abby, wild moves this morning.
It is incredible, John. And to your point that this may be more than investors, traders pricing in December being a little bit softer in terms of hikes. If we take a look at the average volume on the open, more than 110% above the 20-day moving average. Right now, 40% above. That's another way of saying these dip buyers are serious. They want in. And you can see it with big tech. Apple up 4.5%. Microsoft up 4.8%. Amazon, Nvidia, both up more than 6%, the best day since July and May for many of those stocks. So as yields absolutely plunge, you have investors buying the tech weakness, buying that dip. But it extends to this area of weakness that we've had more recently, the crypto bounce. We are seeing Coinbase Global up 8.6%. Big gains right across the board. We even have Block there up 11.4%. So the question around contagion, whether or not the crypto could have some kind of influence for stocks to the downside. Well, it's interesting because if you take a look at Bitcoin here in white and the S&P 500 in blue, a very close correlation. Yesterday, it looked as though maybe that plunge in Bitcoin was going to bring the S&P 500 down. But right now, John, it actually seems to be the reverse. So stay tuned here in terms of this big risk-on move that we're seeing today.
Abby, thank you. We heard from Patrick Harker of the Philadelphia Fed. We're hearing from the Fed's Laurie Logan, of course, of the Dallas Fed, who said this just moments ago. CPI data, a welcome relief, but a long way to go. The message from the Fed, the process of cooling off the economy, quote, is just getting started. This was what Victoria Fernandez was talking about just moments ago. Is the Fed going to make a pivot anytime soon? Based on that, I don't think so. Coming up on this program, crypto exchange FTX heading towards bankruptcy, putting the industry in the spotlight.
We need to have strong global standards to make sure that there are no gaps in the international regulatory framework where you can see risks like this spread.
That conversation up next.
No one covers the world like Bloomberg.
The writings on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched unmatched reach and resources from more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg, your global business authority.
And you're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, so the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Strong global standards to make sure that there are no gaps in the international regulatory framework where you can see risks like this spread and you can have the risk of contagion or even systemic risk spreading to the broader financial system. I don't think we're at that point.
Crypto exchange FTX drawing attention from regulators after a bankruptcy warning. Bloomberg reporting the firm is facing a shortfall of up to $8 billion, needing half of that to remain solvent. The situation prompting rival Binance to scrap its takeover bid. The company writing in a statement, quote, "The issues are beyond our control or ability to help." Team coverage starts right now with Bloomberg's Shonali Basak and Katie Lights for more. Shonali, what a couple of days.
What a couple of days. And now you have Sam Bankman-Fried, the CEO of FTX, online tweeting an apology and saying that he's still in talks with investors to raise, and I say the word liquidity. He does not say capital. He's in talks to raise liquidity. He is trying to make customers whole, and he does say that FTX US, which is the US-based exchange that, operates with people in this country, was not financially impacted by what had happened. And he says that with 100% liquidity there, every user could fully withdraw should they want to. So a lot of people looking to get their money back when it comes to FTX. Sequoia, as you're going to talk about more, is just one of the investors that are facing major losses. SoftBank, other billionaires that have put in money into $2 billion worth of capital raised just last year alone. But to your point, people who put $2 billion in, somehow now there's an $8 billion hole. And how people make that hole full and pay investors back at the end of the day is very unclear and will be very costly as well. His fortune in just a day, $15 billion at least wiped out entirely. We've reported now multiple times that the SEC, the DOJ, and the CFTC are all looking at how client funds were used. Reuters, John, has reported that about $4 billion of customer funds were potentially used when it came to his other investment firm, Alameda, the trading arm here.
And Kelly, that last piece of the conversation, that thought on using client money that Shonali just mentioned, that's problematic in a major way.
Yeah, and we'll have to see what the legal and regulatory ramifications of that are, John, because this is real people's money that we're talking about here, and they already had suffered greatly in the first crypto implosion of the year back in May when Terra USD collapsed, and we saw the ripple effects of that. I will say crypto's getting a bit of a breather today, in part helped by just risk appetite on the rise after CPI, with FTX's native token, FTT, up about 120% on the day, but it has been a bloodbath on the week for people invested in many of these tokens on the week. FTX's token is down 84%, Bitcoin and Ether down 14 and 16% respectively. And I just mentioned Terra USD, John, which of course was an algorithmic stablecoin, another asset-backed stablecoin. Tether is breaking its $1 peg, and that is a sign of potentially further systemic risk as well.
Looking forward to your coverage a little bit later. Special programming coming up with Shanani Basak and Kelly Lyons. I believe Matt Miller interrupted that show too a little bit later. Looking forward to it. 1 p.m. Eastern Time. Peter Cheer joins us now of Academy Securities. Pete, I want to start here. For the people who aren't in this asset class, they don't hold any of this stuff, can you explain to them what this might mean for them, the potential for contagion through traditional asset classes?
Yeah, and I think there's two elements of that. One is what it's going to do to markets. So I think there are companies that are directly tied to crypto. Some, that's their business, whether they're miners, some that's where they develop. That's going to be an important loss, and I think that's going to continue, right? People are not going to rush back into this. I'd be fading this kind of bounce in crypto. The other part is, what does this do for the economy slightly longer term? And I've been arguing for a while that this time when crypto got to $3 trillion, it was a big part of our economy. As it's shrinking, it's now below $1 trillion. You're going to see less spending on semiconductor chips, right? They were huge buyers for these mining rigs, for all the software that they needed. You're going to see less ad spending, right? We might finally be able to get through a sporting event without Matt Damon telling us to, you know, march off to do something exciting. And finally, I think we're going to see less energy use as mining drops. So there's going to be a lot of real-world repercussions from this. And that's going to take a little bit longer to play into the economy.
Pete, is that a tradable story?
Yeah, I think it is tradable. I think for myself, it is actually going to add to the deflationary pressure. I think you are going to see, again, with less semiconductor spending, less energy usage, you are going to see some of this deflation that I think we're already starting to see creep back into the picture if you ignore kind of the erroneous housing data we tend to use. So that is actually going to be good for rates, and that will allow a lot of stocks to do well. I think it's going to remain weak for housing. I think you're going to see some pressure on autos. Anything where these people involved in crypto were spending their money, it's just going to create pressure. So I think, to me, it actually really increases how deep the recession is going to be and the timing of that. So I think we're going to get a worse recession. The Fed's already gone way too far. And this crash in crypto is going to contribute to that recessionary pressure.
You've been talking about that for a while, Pete. Let's talk about this market move right now. Then I've got to move on. Yields down 24 basis points at the front end. Equities up by close to 4% on the S&P. Pete, it sounds to me at least that you'd push back against this move.
No, I love this current move. I think we kind of rally for a little while. I think we're going to see yields come much lower as people realize the Fed's going to have to back off a little bit. And we have to make this transition, right? We're going from, recession to some of this thing's going to look like a soft landing. People are going to start talking about soft landing. We're coming into Thanksgiving. It's always seasonally well. So we're getting all this nice noise. And then I think it's going to be as the data really starts hitting that, this isn't soft landing. This is going to be hard landing. We have crushed parts of our economy. We've just taken out another leg of the economy as crypto's gone down. And that's going to be the reality. So I think we can enjoy this for a week, 2 weeks, maybe get back to 4,200 on the S&P, and then I think the reality sinks in.
Sounds like a bear market rally. Peter, thank you, as always. Peter Cheer there, breaking it down on crypto and this market move. Up 5% on the NASDAQ, on the S&P, up by 3.6% with the sector price action. Here's Abby.
John, well, these moves are simply stunning, and one way to put it, green on the screen. All 11 S&P 500 sectors right now up more than 1%. Energy, interestingly, is the worst sector, up 1.4%. Not surprisingly, mega cap tech on top. Consumer discretionary up 5.4%. Think of Amazon. Tech up 5.3%. Think Apple and some of the chip companies. Real estate, this is interesting, also up 5%. That, of course, is a sector, those stocks, high dividends. So when yields plunge like they are today, the dividends on a real estate sector or, say, the utilities look much more attractive. But the bulls are clearly buying today. And relative to some of the subsectors that are also really outperforming, technology and equipment up nearly 5%. The stocks, chips up 5.6%. And then the FANG index and China tech, it is absolutely soaring, up 6.8% on those yields down, John.
Abby, thank you. Yields down and equities absolutely flying. Up next, your trading diary. The trading diary into the weekend. We're almost there. One more trading day after this one. From New York City, this is Bloomberg.
genetics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
A downside surprise on inflation, sparking a major rally. Inflation comes in softer, weaker, negative, even on core. Look at this move on the S&P, up 3.9%, the biggest one-day move going back to April 2020. On the Nasdaq 100, up by more than 5 percentage points, and yields absolutely plunging. Twos right the way out to tens. On a two-year yield, down by more than 20 basis points, with lower by almost 25. That's the price action. Here's the trading diary. President Biden speaks again at 3 Eastern. Look out for that. More Fed speak. Mess the Daily George, all on deck today. Then we get you, Mitch, sentiment tomorrow. And looking ahead to next week, the G20 kicking off, plus more Fed speak. You'll hear from the New York Fed President, Mr. Williams, Monday, followed by Harker and Barr on Tuesday. Bit of PPI data in the mix as well. Tons coming up. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
The top names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK.
The market environment is a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari-sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants.